Hi, good morning. So, welcome to this webinar. It's probably going to run till around about 11 a.m. UK time, which will be around about 8 p.m. in Sydney, depending on where in the world you're joining us from today. So, before we get into the agenda of what we're going to cover in the webinar today, just a couple of housekeeping points. Firstly, if you can make sure that your microphones are all on mute. You'll note that there's a chat box and a Q&A section. What you can do is that as and when and if there's any questions that you want to ask, please drop them in the chat box. I won't answer them immediately, but I will sort of pause at various intervals throughout the webinar today and address those questions. And there'll be an opportunity at the end of today's webinar to ask any final questions, and any that I don't get the opportunity to address as we go through the webinar, I will pick them up at the end. We will have a break around about halfway through for around 10 minutes, and there will be a recording of this that can be shared with anybody that's attending. And for those people that were unable to make the time zone work, you might be watching this back in your own time. So yeah, before we get into the agendas today, let me just tell you very quickly about how I got into mergers and acquisitions and my very first deal, really to evidence that it is absolutely possible to buy good, profitable businesses without using any of your own money, and that's fundamentally what we're going to be covering off today about how the process works start to finish. So my first deal, when I was growing up, my mother ran a small business, and I suppose that's what piqued my interest in the whole world of business and entrepreneurship. We would sit around the dinner table after school, and she'd be telling us about all the trials and tribulations of things that went on in the business. The business was in the education space. It was a nursery school. And when I was about 19, my mum ran a very successful nursery business in terms of the care and education that it provided to children, but it wasn't necessarily well run from a business perspective, and it used to stress her out quite a bit. So, long story short, I did a deal with my mother to basically acquire the business for £1. She would continue running the day to day, and my role was to basically restructure the business, make sure that it had all the sort of appropriate systems and procedures in place from a business perspective, mainly around accounting, business admin, and after a year of owning that business, I sold it to a group of employees in a sort of management buyout, and that gave us some capital to carry on the M&A journey. So, what are we going to cover today? So, it really starts with how you position yourself. We're going to talk about how you find these deals, how you put them together, everything from start to finish. What you say to owners when they call you back from an outreach, how you handle the sort of typical objections, how you assess whether a deal's worth pursuing very quickly. We're going to talk principally around the leverage buyout type structure, so essentially leveraging the assets of the target business that you want to buy, and use that as a down payment to acquire the business with some sort of creative structure off the back of it, whether it be an earn-out, seller financing. We're going to talk about how we sort of structure the offers and make proposals so that they get accepted by the business owner. Talk about term sheets and negotiation tactics that we use in real transactions. I'm going to talk you through how you actually get these deals funded. We always start with, we're not going to use any of our own money. We're going to purely borrow the money to do the transaction. So whilst it's possible absolutely to invest your own capital into transactions, and maybe that does make funding them a little bit more flexible and easier, it's certainly not essential. We've just completed in the UK a 50 million revenue manufacturing company, completed about 3 or 4 weeks ago, makes about 3 million of EBITDA, and that was a completely no money down transaction. Didn't use any of our own equity, and all of the money was borrowed from the bank with some seller note at the back end. So we'll talk about a few actual examples of deals that we've done, so that we can hopefully bring this theory to life. We'll then talk about the due diligence process, so what really matters versus what wastes time. I'll walk you through the legal process, explained in very plain English, and then we'll talk about what you do once you actually own the business. So how do you grow it? How do you de-risk it after the acquisition? As I mentioned, we'll have a break around about halfway through, and there'll be opportunities for you to drop in the chat box any questions that you may have. So it really starts with positioning. So, if you type into Google your name, what comes up, and really what you want to make sure is that, if you're a business owner that you outreach to, you want to be positioned as a business investor. So, on your LinkedIn profile, any social media profiles that you may have, you want to state very clearly that you're a business investor looking to acquire SMEs in your area of niche. Now, I do work with people that are very sector agnostic. I've done deals in now 33 different industries over the past sort of 17, 18 years of doing this. But if you're just starting out on this journey, my advice would always be to actually focus on an industry that you've got experience in, that you're passionate about. It just makes having those initial conversations with business owners much easier if you've already worked in that industry, you understand it, you have contacts there, you talk the same language as them. So my recommendation would be to make sure on all of your sort of social media profiles, particularly LinkedIn, it says, you're a business investor, you're looking to acquire SMEs within your area of, whatever sector it is that you're interested in, and I'd be even more specific and state what range you're looking at. So that could be, say, between 1 and 50 million of revenue. We'll talk about deal sizes and where maybe the sweet spot is as we go through the presentation today. But ultimately, you want to come across as a serious buyer of companies. Recommend setting up a personal website that positions you in the same way. So a bit of a bio about yourself. And look, if you've not done deals before and you don't feel that you have necessarily the credibility to go out and talk to business owners about making an acquisition, the way that you can build that credibility would be partnering with people. For example, ourselves, we've done now almost 110 transactions. The vast majority of those have been working on a joint venture basis. The reason I'm running this webinar today is to hopefully encourage future joint ventures and opportunities to be able to partner with people. Another way to build credibility as well would be to build an advisory board. So find captains of industry, key people of influence within your industry that you want to buy, and do some sort of deal with them where maybe they get a small percentage in what you're creating. We'll cover that off in more detail towards the end of the presentation today about how you find these people, how you build that board, how you convince them to join you on the journey. And if you have done deals or once you've done your first deal, I think it's very important to position case studies so you can actually talk about live examples. All of those things really help with a positioning point of view. So whatever it says on your LinkedIn, whatever your day job is, you need to remove anything that's completely irrelevant. You want to position yourself as a key person of influence within your industry specialism because of maybe your work experience, something you've done before, maybe you've had a corporate career, and you want to principally present yourself as a serious investor that's looking to buy businesses. And as I say, if you don't necessarily have that credibility, partner with somebody and make sure that their profiles are all connected to yours and on your website. So before we get into sort of sourcing and how you find these deals, let me just talk very quickly about the initial setup. So our strategy is always to use an SPV. So an SPV stands for Special Purpose Vehicle. So essentially, it is a newly incorporated limited liability company owned by you, and that will become the vehicle that you use to buy the shares in the target business that you want to buy. And you'll replicate that structure for every single deal you do. So you don't use one SPV to buy multiple companies. You would use one SPV to buy acquisition number one. If you then go on to do a second deal, you would then set up a separate SPV again owned by you to buy the shares of the target business. And the principal reason for that is to separate assets. If you put everything into one legal structure, whilst the intention may well be to build some sort of enlarged group of companies, from a legal perspective, I'd recommend keeping everything separate. That just means that hopefully, if the deal goes bad, hopefully it doesn't happen. But if it does, it's not going to pull the rest of your group down. Plus, from a funding perspective, and again, we'll talk about this in more detail when we get to the funding section, it's very common for lenders to want to cross-collateralize across group structures. So it's very important to have separate SPVs, separately funded, and that just creates that asset protection. Whilst there's obviously tax considerations to consider, I would say that for the vast majority of people doing deals, 99.9% of the time, you'll set up a limited company in the country in which you wish to do deals. My recommendation would always be to start with the country in which you're based, because you're local, you're on the ground, you can deal with things. We've done deals now in 12 different countries. We're just about to we just signed a term sheet on an acquisition in Australia. So yeah, this is all possible in most Western jurisdictions. There's obviously different legal and tax rules depending on where you're doing transactions, but most of the audience here today are based in the UK and Australia, and this structure very much works. So yeah, new SPV for every single deal, 100% owned by you, and you replicate that structure for every single deal that you do. To set up an SPV in the UK costs about £100. It's about a bit more expensive in Australia. It's around about $500, $600 to do that. So this really starts with, once you've positioned yourself, so I wouldn't do any sort of outreach or sourcing or talking to any sort of business owners until you're completely positioned in the right way. So you've got all of your social media, your profile, your LinkedIn, your personal website up and running, and that positions you as a serious buyer for businesses in the industry in which you wish to go and make acquisitions. So don't do any form of sourcing whatsoever until that is in place. And the principal reason for that is you want to give yourself the best opportunity to engage with business owners, so you need to look the part. Now, I mentioned, and I'll talk about joint ventures later in the presentation, but we do joint venture with people. Most of what I'm going to demonstrate to you around sourcing in terms of how you get the data, the sort of letters and all the process and email sourcing and stuff. What I'm going to demonstrate to you today is very much manual. But if you're joint venturing with us, we do use software tools to automate all of this. So we use things like Tripify, and Instantly to help with sort of automatically sending emails. You can choose when to send them, at what time, how many to send out. You can also use those softwares as well to automate on LinkedIn. So if you're outreaching to business owners on LinkedIn, you can send, you can set it to send however many messages you want to send every single day. And we use Monday.com to manage our pipeline, which creates automations. It links in with things like Outlook and calendars and stuff and reminders, which is very helpful. But if you're starting out, you can use something as simple as a spreadsheet or free tools like Trello, for example. Now, I'm going to demonstrate in a moment how we actually get the data. I'm going to start off with the UK. I'm also going to talk about Australia and other jurisdictions. What I'm going to demonstrate is manual, but if you were joint venturing with us, we've actually built our own software tool that essentially automates all this. So if we were joint venturing, you'd come to us saying, look, I want to buy companies in this range, in this industry, in this geography, and our software will basically pull off the data, put it into a CSV file, send it to you, so you don't have to do any of this with actually getting the data, which is a very time-consuming part of the process. But I want to demonstrate it manually so you can see exactly how we're getting the data, and why it's really quite good data in terms of targeting the right sort of profile of people. The most successful form of sourcing that we found is completely avoid brokers. We've done 100 plus deals. I think only 3 of them have been where brokers are involved. Brokers typically tend to, and I'm not generalizing by saying that they're all like this. I'm sure there are some good brokers out there, but generally brokers charge fees to justify those fees. They probably overvalue the business. They set expectations wrongly, and they can also act as a deal blocker. So we would far rather give ourselves a much better chance to go and reach out directly to a business owner that's of the right age profile, with the right financial profile of company, and contact them directly and engage with them directly, rather than going through sort of third-party brokers. So most successful form of sourcing to do that is to actually write to the business owner. I'll show you an example in a moment of the sort of letter and the outreach that we do. Roughly that gets at the moment around about a 4% response rate. It's very similar in most jurisdictions. So if the data is of good quality, you're targeting companies where the business owner is of the right age profile, they've got the right financial profile, then that's the response rate that you can expect to get back. If you're able to personalize those letters, which obviously does take longer, and I know you can use tools like ChatGPT to do that, but I think it's very easy, I think, to see some sort of communication that's being written by ChatGPT. So yeah, personalised letters is one way to go. If they're really highly personalised, then we've seen response rates as much as 24%. So you've got time versus volume, quality versus volume to consider. And I'll talk you through sort of typical numbers in terms of what I would recommend, how many you need to do to get your first deal. We'll talk about that later in the presentation. The next sort of form of sourcing to complement those that sort of activity of letters would be email sourcing. Typically gets around about 1% response rate, so clearly not as successful as letters. And LinkedIn, very similar, sending a direct message to business owners that are actually on the LinkedIn platform. And then creating PR and content is another good one. So over a 6-month period, if you write 1 to 2 articles every single week and post them onto your LinkedIn, onto your personal website, and after 6 months you'll have created a large library of relevant content. So when I say relevant content, it doesn't necessarily need to be about acquisitions. It could be case studies of deals you've done before. It could be educating business owners in your industry, sharing your expertise, tips on how to improve sales, marketing, how to sell your business. If you go onto my LinkedIn and look at sort of the posts that I create, that'll give you an idea of the sort of content that you can create. So whilst that doesn't necessarily get you immediate inquiries, if you do that consistently every week, as I say, 6 months' time, you've probably got then 26 to 30 articles out there in the public domain that's getting shared, getting commented on. And it also helps from a positioning point of view as well, that it actually gives you more credibility because it doesn't look like you've just set up a profile and called yourself a business investor. For a 6-month period, people can see that you've been talking about this sort of stuff. So I would recommend, as I said, going with a specific industry sort of interests you because you've worked in it, you're passionate about it, you've got contacts there. I'd build a hit list, and I'll show you in a moment how we get the data. Essentially, your first deal is probably in your phone book, so it's probably somebody that you know, or you've got a contact that can introduce you to somebody that might be thinking of selling their business. But you can build a target list of companies that meet your criteria. And I would recommend using the tools that I'm going to go through in a moment. Before we do that, let's just talk about some typical numbers. So to get at least one deal done, this is the sort of numbers that you need to do. So this can be something that you can work at part-time around other commitments that you have, whether you've got a full-time job or you've got other business interests. For the most serious people, I find that those that are able to commit maybe around about 15 hours a week and achieving these sorts of numbers is quite sort of realistic. So cold outreach of 75 a week, will give you one deal now and one deal later. When I say one deal later, you will engage with a number of people. So you can see here that, look, if we do 900 outreach over a period of time, and that's going to give us around 47 responses. That'll turn into 33 first calls. So the difference is some people will respond to say, look, I'm not interested, but you'll have 33 first calls. Not all of them will move to second calls because either you'll qualify them and say that they're not right, or you're not going to move them forward, or the business owner might have the same opinion that there's just not the right fit. So yeah, around about 23 turn into second calls. Most of those will then be prepared to sign an NDA and give you some financial information so you can get to a point of maybe making some sort of financial proposal. When you review those financials, you'll probably find around half of them are viable. And then you'll sort of move towards most of those as a sort of formal offer. Clearly, not everybody's going to say yes. Some people will say yes, some people will say no. There'll be objections, etc. So you probably expect to sign 2 term sheets. So a term sheet is essentially a basic document that maps out what the deal is. We'll cover that off later in the presentation today, and then we'll talk. And then that typically will get you one deal now and one deal later, because of those 33 first calls and 23 second calls and 18 NDAs that you know then go and look at financials for. You know, if they're very much early in the journey and haven't had some pain in terms of trying to sell their business, it might take them 9 to 12 months to come to the realization of something that's more realistic. So the reason I say one deal now, one deal later, that 900 outreach should give you a deal you know, within sort of 3 months of doing that sort of activity, and another one maybe in 9 or 12 months later. So, yeah, if you're doing this all manually, well, to get the 75 records that you need to do every week is probably going to take you just shy of 4 hours. If you're going to do the personalised approach, again, similar sort of time scale, you probably say, you know, first calls maybe take 30 to 45 minutes. Second calls maybe a little bit more detailed, maybe up to an hour. And then, you know, half an hour of analysing deals and, you know, making a formal offer probably takes about an hour in terms of a presentation, a conversation. So, yeah, in a typical week, you know, 14, 15 hours doing that sort of activity will lead you to a deal. So let me show you some of this sourcing. I'll just come out of these slides. So before I show you where we get the data from, let me just show you the sort of letter we typically. So we've tried many different approaches. We've tried using corporate headed paper. We've tried, you know, doing very detailed letters. We've tried, yeah, many different forms, and this is the one that gives us the best response rate. So you have your details here at the top from the desk of Paul Seabridge, your phone number, email address, the name and address of the business owner, addressed to them regarding the company. And it quite simply just says this: forgive me for writing to you at your business address, but as the contents of this letter are potentially sensitive, I thought it's better to approach you this way in the first instance. I'm a private investor interested in acquiring companies in the whatever industry you're involved in. And from our research, it would appear that your company could be of interest to me, having already acquired a business in, you know, so obviously you'd only write that if you have actually acquired a business in that industry. Leave that out if you haven't. I'd welcome confidential discussion in the first instance. It cannot hurt to have a chat around subject on a nothing ventured, nothing gained basis and see how it goes. Please call, text, or email me on the above details to discuss further your signature and your contact information. So really simple, very vague letter, very non-committal, but that seems to get the best response rates. So let me now show you where we get the data from. So share the screen. Okay, so I'm going to show you how to get the data in the UK, how we get the data in Australia, and I'll also talk about other industries. So there is a website called mdole.co.uk. You can sign up for free. The free version allows you to get up to 100 records, or you can subscribe where it will give you unlimited. So the subscription is around about £50 a month, and you would go to their Explorer product, and you would basically create a new advanced search. So this is the key criteria that we'd look at. So firstly, key data. We want active companies only. We don't want any closed companies. We don't want anything in liquidation. We don't want anything dissolved. We just want purely active companies. So you can see here how many companies are now filtered. So in the UK, there's currently just shy of 5.5 million active companies. We ignore all of those ones there. Date, we want companies that have been established for a reasonable period of time. So I'm just going to put in between 1950 and 2020. So they're going to be at least 6 years old. And you can see here, when we add that there's now 2.7 million companies in the UK that were incorporated between those dates that are active. People. We want directors' age, people over the age of 55, over 65, the baby boomer generation. Around about a third of companies in the UK are owned by the baby boomer generation, so people over the age of 55. They've created probably a successful business over many years, and they might be now contemplating retirement. These are the ones that we're going to target. Ownership. I always recommend going for no more than three shareholders, and the principal reason for this is that, look, if you've got 6, 10 shareholders, then you've got 6 to 10 other people that you've got to convince to do a deal, and they might all have different motivations. So, ideally, you're looking for the sort of family business that's maybe owned by husband and wife, or maybe three shareholders. And that just gives you a better, I suppose, opportunity. There's nothing wrong with going for more shareholders. It's just you want to give yourself the best chance to start with. Look for maximum three. So as you can see now, we've got 1.1 million companies in the UK that meet this criteria. Location. I'd recommend going to start with, whilst you can do the whole of the UK. I'd recommend picking a sort of region within maybe a sort of 2-hour drive from wherever you're based. So let's just say you can either search by region, or you could search by county, or you could search even by postcode. So you can put in the geography that's of most interest to you. Nothing wrong in going for the whole of the UK, but I'd say that whilst our process isn't necessarily to go and meet with business owners face to face, and we'll talk about that as we go through the sort of sales process that we follow with them. And clearly, if there is an opportunity to meet with them, well, driving somewhere relatively close is better than driving to the other end of the country. Industry. So I would put in here, whatever your industry specialism is. So let's just look for manufacturing companies, and you can niche this down depending on what type of manufacturing you were looking for, whatever your industry is. And then financials, you want current assets between 1 and 10 million, and you want net assets between 1 and 10 million also. Now, let me just explain those financial criteria. So in the UK, if you have a turnover below a certain level, you won't be filing full accounts. So if you, as you'll notice here, you can actually put in turnover and EBITDA. The problem with those filters here is that if you don't file full accounts, this won't pick up the sort of turnover or profit. So if they have current assets between 1 and 10 million, in most SMEs, the current assets tend to be the receivables. So if you've got, say, 5 million of receivables, and most customers tend to pay you within 60 days, then it suggests that your turnover might be somewhere in the region of about 30 million. So if you put in current assets between 1 and 10 million, that's probably going to pick up companies somewhere between the sort of 5 and maybe 50 million, 60 million revenue range. The average sort of margin for profitable companies tends to be about 10%. So if you pick up a £5 million company, it's probably making 500 grand profit. If you pick up a £50 million company, it's probably making 5 million of profit. So we ignore all of those, just purely use the current assets, and net assets enables us to get companies that have got a big enough balance sheet that potentially we can fund against, and that they're not in an insolvent position. And that's essentially, the criteria that we would use. So we can see here active companies that have been established for more than 7 years, where directors are over the age of 55, maximum 3 shareholders in the northwest of England, with the financial criteria of 1 to 10 million net and current assets. In the manufacturing industry generally, there's 935 companies come up in the search. What you would then do is you would look at each one of these, and you would open them up in a new tab and do a bit of research and get the data. So just to give you an example, here's one that we did earlier. So we've gone on to Companies House, we've typed in the name of the company, this engineering business here, and we can see here, when you click on people and you click on persons with significant control, you can see that this individual here, who was born in 1954, so obviously is in the right age bracket, who owns more than 75% of the shares, is the person that we would essentially write to. So we'd record his name, his address, and we put it into a spreadsheet that you can then use to mail merge with your letters, and then you would send that letter template that I came up before. You can also, and you don't need to do this because Endol's done the work for you, but you can also look at the financial statements of the company that have been filed. In this instance, this company's got about 1.5 million of, I think, net assets. So potentially is files abbreviated accounts. There's no profit and loss here, but potentially could be a good target. For jurisdictions where maybe the level of so the great thing about the UK is that the level of data in the public domain is pretty good, so you can really filter very well to pick up businesses where an owner's of an age profile with the right financial profile. But places like Australia or the United States, the same level of data is not in the public domain, so it's a bit more of a long-winded process. So, I mean, you can follow exactly the same process for the United States, but essentially, I can go to Yellow Pages in Australia. I can look for engineering companies in whatever area. So, I'm looking here at Melbourne. In Victoria, we've got this company here that's come up in the search, Extra Engineering. There's this website here then called aussiebiz.com, where you can search the company. You just put in the business name here. It will give you the name of the business owner. It will give you their email address. Again, you've got their details to write to them at. You can then also look them up on LinkedIn. So we can see here that this company has between 11 and 50 employees. Now, a company that's got that sort of level of employees is probably going to be of the right sort of size. So I know it's not a complete accurate measure, but yeah, any company that's got basically 10 plus employees, maybe maximum 250, is probably where I'd be looking for. And then you can look for, again, if this website doesn't always give you the owner's details, but you can look up on the LinkedIn. You can see here's the name of a director. You can connect with this individual, or you can find out his full name and write to him. So a bit more of a laborious process, but that's basically what we do, and that gives us again a similar sort of response rate. So let me go back into the slide presentation. Okay, yeah, we spoke about it. Yeah, other ways to source, as I said, your first is probably in your phone book. Essentially, mine sort of was it was my mother's business, but my deal number 2, deal number 3 were people that I knew. So I probably work your contacts first, ring them up, tell them that you're looking for acquisition opportunities in that space, and see where the conversations lead. When you acquire a company, the first place I probably look at is their customer base, the supplier base, to see whether or not there's any warm relationships with other business owners of the right sort of age that you potentially contact. Social media groups, there's groups on LinkedIn, particularly for manufacturing business owners, marketing agency business owners, entrepreneurs groups. You can go in there, you can post your content. So I probably wouldn't be saying I'm looking for businesses to acquire. I'd build a relationship with the audience first. So that's really creating relevant content to them that's going to be useful. So business tips, etc. Networking and industry events can be good, and if there's any specific industry trade press, trying to get some of your articles that you write published in there can also help generate inquiries. There are many other ways to source. I'm not going to cover absolutely every today, but I guess they're the principal ones. But yeah, letters directly to business owners of the right age profile, the right financial profile is really where we would start. So we've done the outreach, we've sent them a letter. We're now going to get responses back from people. It typically takes about 4 to 6 weeks to build momentum. And the key thing really is to make sure that every week without fail, you send out those letters. So if you're going to do 75 a week, every week without fail, you make sure that those 75 get mailed. And that will give you, that will start to fill your pipeline. Not everybody responds immediately. Some people might, sit on the letter for 2 or 3 weeks before they contact you. So it's just important to keep that consistency and momentum going. But yeah, after sort of 6 weeks of doing this, every week you should be getting, several calls back. So the initial calls are structured. I'll give you a bit of a script in terms of what we cover off in a moment, but the principal purpose of the initial call is to build rapport. Once you've got rapport, you get trust. Once you've got trust, you can then essentially sell yourself as a buyer. You can sell them the deal structure that you're going to put together. You can't get them to do a deal with you if you don't have that trust, and you won't get that trust unless you build that rapport. So first call probably takes between 30 and 40 minutes, and you're using this really to as I say, not just build the rapport and gain the trust, but you're also qualifying them to see whether they're serious, what their motivation is, and you're also delivering some very key messages around who you are as a buyer, what you're going to do with the company, how you structure deals. So it acts almost as a bit of a filter that if they don't like anything you say, they don't like the way you do deals, they don't like the way you're going to structure them, then it means that they won't probably have another call with you. So, time is precious, and we've developed this process, very structured process that works. So the summary of the first call really is, initially you'll do some introductions. They're going to talk a lot more than you. So you're probably going to ask them, quite a lot of sort of open questions to understand what their motivations are and a little bit more about the business. You're then going to deliver some key messages around how you structure deals, the legal, financing, and all of that sort of stuff. You're going to position yourself as a safe buyer. I think people think that it's all about the money. I would say that, it's probably 50% about the money in terms of, they built a business, they want to capitalize on it. So, the financial components of what they're actually going to get paid for it is important. But I would say that the other important side, the other 50% is who they're selling to. Are you going to change the name? Are you going to fire the staff? Are you going to restructure things? And that most business owners care very deeply about what they've created. So anybody that's going to do any of those things, they're probably going to run a mile. So you need to really position yourself that you're not going to do any of those things, and your job is to build upon what is already a successful business and sort of take it on to the next level. You're going to demonstrate your experience in mergers and acquisitions and industry. As I said, if you're starting out, haven't done deals before, partner with somebody so that you do have that M&A experience. And then the final part of the call is to close them for the next steps, which essentially is to book in another call. So let me show you a sort of typical call script that we go through. So pull that up. So I'm not a big fan of scripts, but this is really to demonstrate the sort of conversation that we would have with a business owner. Having done this now for sort of 17 or so years, I guess this is like second nature to me, but I thought documenting it all would be helpful for you. So first call, thank you for responding to my email or letter, however you contacted them. The reason I wanted to speak to you is that I'm an investor. I'm looking to acquire a company in your industry. Obviously, this is for me, so I'd say I'm part of OPC Capital Partners. We're a global mergers and acquisitions firm. We've completed over 100 transactions since we started in 2010. And I'm interested to explore with you, whether an exit and a sale from your business is something that you're looking to do at the current time. You could change that bit to, I'm an investor. I have X amount of years experience in the whatever industry. You can adapt that accordingly. I'm interested to see if they're going to explore an exit from their business. They're going to tell you, well, yeah, maybe I'm thinking about it. Maybe of a certain age, maybe I've got other issues that might mean that I need to sell. And then you want to really sort of dive into, perhaps they can give you a bit more background on the business. You want to ask them a load of open questions before you then carry on with the script. So let me just go down to the open questions. So we've got, these are just sort of generic questions, really. So yeah, give me a background on the business. Can I ask, are you in a process to sell the business? Have they engaged anyone to assist you in that process? Or is this one of the first conversations that they've had in this regard? And really what you're wanting to do is understand, have they listed it for sale? Have they engaged an advisor? Are they already talking to potential buyers? Or are you one of the first people they've ever spoken to? And really that helps you assess, whether they've maybe had some pain in the past in terms of if they've been trying to sell it for 2 years and without success, then they've probably had multiple offers that aren't acceptable, or they've had some bad experiences. Equally, if they're completely new to the process, never sold a business before, and this is the first ever conversation they've had about the same subject, then your job is to probably educate them more then around the process and how you do deals and how it all works. So if they have done something about it, I want to know, have you had much interest? Have you had any offers? Why did you not accept those offers? What feedback have you had? How long have you been in the process? Other questions to ask when you sell the business: is there already somebody in situ that can take over from you, or do you think a new owner would need to take your place or recruit somebody. And really what you're wanting to do here is understand whether or not the business is succession planned. I would never buy a business where the owner's going to leave and there's nobody to take over from them. So I would, this is a qualifying question for me. This is just a personal thing from my own experience. It's, when the owner leaves, if there's no one to take over from the day to day of them, and you have to recruit somebody from outside, even the most experienced operator, won't have experience of actually running this particular business, won't necessarily have relationships with customers and staff that the owner has, and that creates a huge amount of risk to that goodwill. So personal preference is to only buy a business where there's somebody already in place, or they've identified somebody that can be promoted to managing director to take over from them. I then asked them, have they thought about how long they might be prepared to be involved in a handover? And then I would sort of set their expectations that you would expect them to probably be in a handover for sort of 6 to 12 months, so that we can learn the business and spend time building the relationships with staff and customers and suppliers. So initially for the owner, this could be full time, but as time ticks on, it might be just once a week popping into the office or being at the end of the phone. Aside from the financial components of the deal, is there anything else that's important to you? And really what you're trying to find out from them is, what are they looking for from a buyer? Money to one side, are they looking for someone that's going to, sort of maintain the business and build on it, or come in and sort of wreck it? Have you given any thought what you want to sell the company for? Now, most of the time they don't tell you, but if you don't ask, you don't get. So it's always a question that's worth asking. What timescale have they got in mind to sell the business? So again, you can sort of filter out those that might be thinking, well, maybe in 5 years' time rather than now. And so, yeah, they're probably enough of the sort of initial questions that you can get them talking, and obviously that will lead you to other questions off the back of their answers. So once you've got a bit of a feel for, they're thinking of selling soon, they're motivated to sell for whatever their reasons are, and you think that the business, from everything they've told, seems like a decent one, they've got somebody in place to run it. Once you've got to that point, then this is where I'd start delivering some key messages, really to set their expectations. So thank you for sharing that information. Let me tell you a little bit more about us, the type of buyer we are, how we typically tend to structure deals. And then if you feel positive about what I'm about to say, then we can work out what the next steps are. So the first thing for me to say is that the reason we want to buy long-established profitable companies in your industry is we want to use it as an anchor to grow, principally through acquisition. Ideally, we want to make tactical and strategic acquisitions in this industry to form a larger group. And the reason for that is when you put companies together, you can drive a whole host of benefits, whether it be economies of scale, buying power, etc. So we see ourselves more as a facilitator than an operator, in that we'll bring the tools, the resources, and most importantly, the capital to the table to enable the business to grow, working with the existing management team to grow the company. So it's not about changing things or trying to invent the wheel. We won't be changing the name. We won't be firing the staff. Quite the opposite. We'll be probably looking to add more people as we grow. It's really about building upon what is already a well-run, profitable, established company and taking it to the next level. So really, you've just positioned yourself there as a safe buyer, and that's what your intentions with the company will be. Next step will be, let me tell you about how we structure deals. So there's many different ways to value a business, but what I found in my experience is that ultimately it boils down to what you as a willing seller will sell for, and what we as a willing buyer are prepared to buy for, and whether those things are aligned. So generally we tend to look at the profits of the company, and then we'll base the deal on either the most recent financials, or maybe we take an average over a period of time. We'll then also look at the balance sheet to see what assets and liabilities we'll acquire on closing, and we sort of add these two things together. Typically, we don't pay all of the purchase price at closing. We'll pay a meaningful sum, but there's always going to be some degree of stage payments. And the main reason for this is that there's always a risk when there is a change of ownership that customers may go elsewhere, suppliers may get jittery, or key staff may leave. So we ask you're involved in the handover of the business so we can protect this goodwill. First part is to understand how you run the business. So essentially you train us how you operate. The second part is for you to hand over the relationships you have with your staff, your customers and suppliers. That's done gradually, and it just ensures that everything's done orderly and efficiently. So whilst you might not need an incentive, if you've got a vested interest, you haven't had all of your money at closing, and there's some part of that that's going to be paid in the near future or conditional on certain things, then you're more likely to stick around and help us work through that handover effectively. So essentially, you're basically telling them that you're not going to pay all of the money. There's going to be some sort of seller financing, so that they need to be comfortable with that. What I would then do is get into the sort of closing stages. So the next steps, Mr. Business Owner, if you're interested to progress, would be for us to put in place a non-disclosure agreement. This enables us to share confidential information between us, and once that's in place, we can arrange a more detailed discussion. So shall I organise an NDA after this call? You have it emailed to you, or if you have your own version you prefer to use, we're happy either way. And it's very important we just sort of close them down for, if you're going to send it to them, when do they think they'll sign it and get it back to you? Because obviously if they don't send it back when they say they are, you can chase them up. The second call then is very much a repeat of the first. It just tends to get into a bit more detail. Again, a lot of open questions, but you're probably going to want to understand more around the business, more around the motivation, and you're going to, again, deliver some more of the key messages to set their expectations, but in a bit more detail. So some open questions around the business could be: who are your customers? How long have you been doing business with them? Who are the main suppliers? Who are the key people in the management team? How long have they worked for you? Are there any gaps in the experience or skills within the management team that we may need to plug? What does a future pipeline look like? Do they have any long-term contracts, or is there any business that they're about to win? How does financing work? Do they have an in-house accounts department, or do they use an external accountant? What does that look like? Where do you see the growth opportunities for the business as a buyer? Obviously, you can ask many more questions and probe further based on whatever their answers are there, but that just gives you a sort of starting point. The motivation questions: so why is now the right time to sell the business? What do you want to sell the business for? Have you given any thought to what you're going to do with the proceeds of the sale? Do you need a certain amount at closing for anything specific? Have you looked at what you think you may invest some of the proceeds in of the sale for passive income? If so, what on, and what sort of returns do you expect? Those questions are quite important because, look, if they don't tell you what they want to sell the business for, but they say, look, I do need some money at closing to pay off my mortgage. I want to help my kids out, get on the property ladder. I want to invest some of the proceeds into maybe some rental properties or into some stocks and shares to create some sort of passive income. You can use those questions to come up with some sort of intelligent ideas as to actually what they're looking for, in terms of what the closing amount needs to be, so that when you actually come to the offer, and we'll obviously talk about this when we get to the offer stage, you can essentially sell this back to them. So look, I've got a deal here for you, Mr. Business Owner, that enables you to pay off your mortgage. It helps you, it enables you to help your kids get on the property ladder that you mentioned, and it also gives some of the proceeds to create a passive income. And this can also be used to justify the deferred consideration, because look, if they're looking to maybe just sell up and invest the cash into, say, rental properties. Well, with rental properties, you've got tenants that potentially can have problems. You've got repairs and maintenance. You've got to deal with agents. The returns actually aren't that great. Where what you can do is you can actually position the deferred as a passive investment. So, instead of you investing all of the proceeds into buy-to-lets and having all of those problems to deal with, just deal with me. I'll pay you your capital back every year or every quarter or every half year. I'm going to pay you a better interest rate than you would get if you were to invest in the property market. And you've only got me to deal with. And I mean, obviously, there's still risk associated with that. But look, if they're selling you a good business, they're confident that the business is going to continue to have the profits that it's historically had. Then there should be no reason why they can't see that they're going to get paid that deferred amount. And if you're incentivizing them with a better interest than they would get somewhere else, again, it's another way of sort of justifying the whole seller financing. Some key messages that you want to deliver. Some of this is a repeat of the first call. Some of this is more detailed to set their expectations. And the idea is in the second call is you're going to sort of set their expectations around deal structure, how you fund it, and seller financing and handover periods and all of those sorts of things, so that they're only going to move towards maybe signing, maybe giving you financial information and progressing maybe to offer stage if none of this puts them off. So this very much acts as a filter. It sets the expectations. So it also saves time that you're not going to go and spend a load of time seeing how you're going to structure the deal, make the offer, for them to come back and say, well, I don't like seller financing. I didn't realize you were going to finance it with some seller financing, or I didn't realize you were going to use debt to structure the deal, or I didn't realize I needed to be involved in a handover for a year, because you've delivered all of those key messages. So the valuation and deal structure bit would be, when we spoke last time, you mentioned that you'd given some thought to what would make the deal work for you from a practical sense. What I want to do now is just sort of dive into how we get to a point where we can make you a financial proposal. So the way we would normally structure something would be we'd look at the underlying profits of the company. Usually we take EBIT or EBITDA, so that's earnings before interest, tax, depreciation, amortization, and either we'll take the most recent financials or we'll take an average and we'll apply a multiple to that. We'll then look at what the balance sheet says, so what assets and liabilities we'd acquire at closing. We typically add those things together. That gives us an overall purchase price that we can then present to you. In order for us to get to that point, now that we've got an NDA in place, if you were able to share some financial information with us, this will enable us to give you a ballpark idea of what we think that looks like. So it won't be a formal offer at this stage, but it does mean that we can have the whole financial conversation early on in the process. So if for any reason we were not aligned on that, then neither of us waste each other's time if we can't get past the financial component. So would you be happy to share some information so we can get to that ballpark? In terms of justifying the deferred payments and succession planning, so if they've said, you mentioned that you've already got somebody in place to take over from you. I also mentioned that last time when we spoke that when we structure a deal, we never pay all the purchase price on completion. There's always a risk that when there's a change of ownership, that customers can go elsewhere, suppliers can get jittery, and maybe key staff might not like the new owners and they may leave. So we don't want any of those things to happen. So even if there is somebody going to be in place to run the business, we'd want to be having you involved in an orderly handover. Obviously, if there wasn't somebody in place, we'd work with you to identify a successor, and we'd have you involved in helping us select that right person. As I mentioned, that would be a deal breaker for me. I wouldn't buy a business without a successor in place, but you might have a different view of that. With some of the purchase price left to be paid, this gives you a vested interest in helping ensure that we protect this goodwill together so we can build upon your legacy. So essentially, you're just justifying why you're doing deferred payments. Deal structure and funding. I think it's really important to tell you how we structure the deal legally and how we fund it. So firstly, we use a newly incorporated limited company that I'll be the shareholder of. That company will buy the shares of the company, and it will sit as a wholly owned subsidiary. There'll be two elements to the funding of the deal. Firstly, we'll use debt, which is injected into the holding company and your company, which will then provide the initial payment at closing. And the second part is an element of seller financing, deferred payments that will be structured with the appropriate loan note and security. You could get into more detailed conversations around, why banks find SMEs really high risk, why high street banks typically don't fund these types of transactions, that you have to, to bridge the gap, the seller needs to be the creative one and almost play the role of the bank, because the banks won't lend the full purchase price. You can get into all of that. Timescale, we're keen to proceed if we get to a point where an agreement on a deal structure. Normally it takes 3 to 4 months from negotiating a deal to completion. During this time, we'll need to undertake due diligence. Our due diligence isn't too laborious in that we'll give you a checklist of information. We can look at all of that in a secure data room and review it remotely, so we don't need to come on site. This goes as quick as you can provide us with that information, and this normally covers legal, financial, and commercial aspects. Lawyers are engaged to draw up the contracts and legal paperwork, and we'll raise the funding. All of these things run concurrently, and typically it takes 3 to 4 months to conclude. And we find it's best to work together proactively to work through this process swiftly and efficiently, as no one wants either party to drag their feet. You may get objections at this stage. It might be later on when you get to making the proposal that they come back with objections, but typically the objections tend to be around valuation. So really it's just about reiterating what a willing seller's prepared to sell for, what willing buyers prepared to buy for. SMEs are high risk. There's a lot of dependence on the owner, even if succession planning has taken place. Research from Harvard Business School shows that the average sale price for a SME is 2.5 times, and most that are listed for sale don't actually sell. Not having enough upfront really tends to relate to actually not that specific issue, but it's more about trust and relationship and track record. So, partnering with somebody like ourselves, we can demonstrate other deals we've done where we pay people early, and really they're worried about their risk of not getting all of the rest of the money. So it's really about that trust and relationship. Same if the deferred payment period is too long, they want their money within 1 or 2 years, but you might be offering them 3 or 4. Again, they're just trying to mitigate their risk. We'll talk specifically about security when we get to the sort of offer stage of what you can offer to mitigate those risks. Most of the time, sellers are I would say 95% of the time are happy with the handover period, so it doesn't tend to be an objection. And usually only those that object to that is because there's something specific that might be preventing them from doing that. So, for example, if they've got a health reason, for example. Yeah, we've covered that bit. So that's a sort of typical script that we would use, that we would process with a business owner. So let me go back into the slides. Yeah, just a word on objection handling. I think a lot of it is about empathy, so showing that you understand what the concern is, and then trying to come up with an appropriate rebuttal that deals with their issue, and then trying to mitigate whatever their concerns are, which is usually around risk and how we do that. And we'll talk about that when we get to the security section. Um, yeah, let me just. We've spoken so far around sort of seller financing and leverage to generate the down payment, but this is the deal pie. So there's lots of other things that you could offer in negotiation. So cash is one. So in certain jurisdictions like the UK, it's not uncommon for a business owner over many years to build their business, take out what they need, gives them a comfortable lifestyle. But if the business is particularly profitable, it doesn't make sense for them to take all of those profits out of the company because we clobbered with income tax. So it's very common for us to see that, a lot of these sort of SMEs that have been established for 20, 30 years have accumulated a lot of surplus cash, so surplus to working capital. If we structure the deal with their cash, there's this thing called business asset disposal relief. So essentially, it means that if it's structured in the right way, they can take the cash at closing and only pay capital gains tax on it. So in the UK, that's between 14 and 28% at the moment, which is a lot lower than the sort of 30 to 40% income tax rate. So it can be, on £1 million, they can save themselves maybe 250 grand. Earnouts, so if they want more money, well, look, if you've asked them some questions around future business, long-term contracts, business they're about to win, then you can say, well, look, I'm happy to share the upside. You've got to deliver those contracts, but if you deliver, then I'll pay you some more money. So it's a sort of win-win. You could actually leave them with equity. So, you can sell them on the whole buy and build model of, you're going to build something larger that hopefully is going to be a lot more valuable. So if you leave them with 10, 20, 25%, that has a value for them, and they can have an involvement in the future of building the group. If it's a recurring revenue model, then maybe you can negotiate some sort of royalty or commission. If you already own a business in the sector, then maybe you can talk about mergers to create a larger business that's more valuable. You can tap up creditors, suppliers, customers to potentially use for sources of funding. So I was involved in a construction-related business where one of the major suppliers was the relationship with this particular company was very strong, and they spent a lot of money with this particular supplier, and the supplier actually gave, it wasn't actually for the actual deal itself, but they gave a loan to the business to support working capital. That's how much they recognised the value that this particular company had in terms of it being a customer. We've spoken about share purchases. You can do an asset purchase, although funding is almost impossible without PGs. In the United States, there's SPA loans. We're not going to cover that because I don't think the audience is in America today, given the time difference. But SPAs is certainly something that could be looked at for the US. And then, once you've actually created a larger group of maybe 3 or 4 companies, you can refinance, you can get revolving credit facilities, you can raise funds from the capital markets, you could even look at listing the business. So there's lots of other places to go for deals. Let me show you an example very quickly of the NDA that we use. So you can see this, you can get these sort of templates online. So our NDA is a very simple one page. So I appreciate it's small print, but you fill in all the details here. You really make it easy for them, and it just basically says we're going to share info, they're going to share info. We agree to keep it confidential between ourselves and our advisors, and that's essentially what it is. And they both sign it, and it's probably something that you then put in a drawer, never to be referred to again. But it enables you to share information. So let me go back into slides. So let's talk about the deal structuring, how this sort of works. I'll actually show you a spreadsheet shortly of how we actually analyze a deal and come up with a sort of ballpark idea as to what we're going to do to structure a deal. So in a leverage buyout, essentially what you're doing is you're using the assets of the business as collateral to raise money to create a down payment. And typically in most businesses, we're not using maximum 70% of EBITDA, but ideally no more than 50% to service the debt. And when I say service the debt, that's any debt. So that could be any debt you raise from institutions to fund the deal. It can be seller financing, interest on their loan note, etc. The total amount that it costs you in capital repayments and interest every year, seller and institutional debt, is no more than 70% of EBITDA, but ideally 50%. And what that essentially means that is if for some reason you take over and profits halve, you can still service the debt. So the sorts of percentages that you can borrow against assets, real estate, typically you can borrow between 50 and 70%. Most of the time you can do that on an interest only basis. You can also be creative with real estate. So, there are investors out there that will do sale and lease back. So they buy the property at the same time that you buy the company and they rent it back to you. So essentially that gives you 100% of the real estate value that you can give to the business owner. Typically takes 3 to 6 months to raise that sort of funding because lenders want to, probably do a valuation survey on the real estate. They want to check the legal title and all that sort of stuff. Does take time. Invoice finance. So most of these businesses will have an amount of receivables, so money its customers owe it. You could borrow against that in an invoice finance facility. You can borrow up to 90%, but I'd probably say to fund these deals, you probably want to be more 70 to 80%. And that's probably the easiest form of funding to raise. So, I guess one of the myths with leverage buyout is you've got to buy these industrial businesses, factories with manufacturing plants, very expensive machinery, because that's what you're going to use to borrow against. Actually, this works really well in B2B service industries where actually their only asset is probably their receivable book, because you can just put invoice finance in place to fund these sorts of transactions. What the lenders are most concerned with really is the credit risk of their customer profile. So, is there credit insurance in place? If not, can there be? Do customers pay them within a reasonable amount of time? So no. Usually that's under 90 days, which for most businesses, that's sort of typically where it tends to be. Plant and machinery. So, if it is an industrial business where it's, say it's an engineering business with expensive CNC machines, well, you can borrow between 33 and 75% of the liquidation value. So the liquidation value would be something that a lender would deem if they needed to take all of that kit to an auction tomorrow, what would they sell it for, which is going to be quite a bit lower than maybe what the actual book value could be. Fairly straightforward to arrange. Again, the lender would normally look to get a formal valuation, and that takes 3 to 4 months. Stock finance, inventory finance, really is very difficult to get, and it tends to apply really for any big ticket items. So, if you're selling plastic widgets for $1 and you're shipping them in from China, you're not going to get inventory finance against that. But if you're selling motor vehicles to customers, then you can probably get stocking finance against those sorts of assets. Cash flow lending is also possible. So you can lend up to 4 times EBITDA less debt, including any deferred. So, if there's a seller note, that would come off the amount that you could lend. All of those types of funding are possible without putting your own money or signing a PG. And we'll talk specifically about how to deal with that with lenders when we get to the sort of fundraising section. But all of those, except for cash flow lending, can be done without PGs. Cash flow lending typically won't be possible unless you're going to invest between 5 and 20% of your own personal equity into the transaction, and the bank will then make up the difference. And it's certainly not possible without a PG, and that's across most most jurisdictions. It's possible to get term debt as part of a sort of LBO package. So if you took out invoice finance or plant and machinery finance and you wanted to top up with, say, a 250 to 500 grand loan to amortize over probably the same period of time as as the seller note, then that's possible. But it's usually not possible to get term debt on its own. It's got to be part of the leverage structure with the asset sitting behind most of the borrowing that you will do. So let me show you a typical analysis of how we sort of structure deals on a spreadsheet. So there's two sides to our analysis. The first is to get to this ballpark idea. So this sort of spreadsheet probably takes about 20 to 30 minutes to properly analyze, and this will give you enough information to be able to go and pitch them a sort of ballpark idea as to what a deal looks like. So by that, I mean, you're sort of saying to the seller, look, Mr. Seller, if we're going to do a deal, this is what we think it looks like. It's going to be this as a purchase price. This is going to be paid up front. This is going to be paid over a period of time. This is what the time frame is. That's what it sort of typically looks like. If they then sort of feel comfortable, I mean, they'll always say no, but, you know, if it just needs to be tweaked or, you know, increased slightly, fine. It's really, you know, if they've got material differences, like we had one today where earlier an Australia deal where we'd offered them 6.8 million on a business that was making 1.8, but they actually wanted 11.5. Well, we're not going to be able to get to that. It's too far of a gap to bridge. It's not worth it. So we will just park that and revisit it in 9 or 12 months' time when they may become more realistic. But if they come back and say, well, do you know, 6.8 doesn't quite work, but if you can get to 7 point something, and I think we can do it, then, you know, that would be something that we could look at. So the idea is to get to a ballpark figure. If they're positive about it after maybe some brief negotiations, that's when we then dive into a much more detailed analysis where we do a sort of financial model over the period of time that the seller note is going to be paid for, so that we can sort of stress test different scenarios and come up with a formal proposal. But that formal proposal is going to be very much in line with this. It's not going to differ materially, but we won't go to the work of doing a very detailed financial model that probably done properly takes a couple of days. So this is really just to have that initial financial conversation. So the first side is we'll look at the P&L. So we typically will look at the last 3 or 4 years. So we can see in this scenario, this business has got 8.3 million of turnover in 23, dropped slightly to 8 million in 24, and dropped again slightly in 25 to 7.7. Gross profits 4.4 down to 3.7. The margins have dropped from 53 to 48%. So I wouldn't say any of that is like material. I'd obviously probably want to question, you know, why have they lost, some of their revenue? Why have their margins tightened? And be able to explain that. Then got their operating profit across the year, so they've gone from 2.3 down to 1.2. So still a reasonably profitable business. We've added in the interest and the depreciation, which then gives us the EBIT and the EBITDA. If there are then any add backs, we can consider them here. So, you know, if they've got a family member on the payroll that actually does not work in the business, so that would be a cost that wouldn't be replicated post transaction under new ownership. That would be a genuine add back. Most of the time with add backs, they tend to be genuine costs of the business. And, you know, even things like, you know, the owner might say, well, you know, I'm paying, I have a vehicle, a company vehicle. So, you know, when I leave, that's not going to be a cost anymore. But most of the time, those vehicles will be on 2, 3, 5 year contracts. So that isn't necessarily always a genuine add back. So, yeah, we want to get to a sort of EBIT and EBITDA figure. We'll then go and look at the balance sheet. So we're going to look at what the net assets are. So in this case, 4.5 million. We then will adjust and normalize the balance sheet. So if there's any directors' loan accounts that need to be grossed up, if there's any intangibles, typically we reduce the balance sheet value by those because, you know, they might have a value to the company, but from a funding perspective, you can't fund intangible assets. If there's any other adjustments that need to be made. So in this example, there's a deferred tax liability. This then gives us the adjusted net asset figure. So the 4.5 less the 853 gives us the 3.7. We then look at working capital. So current assets less current liabilities gives us working capital of 1.8. So 3.1 less 1.3 gives us 1.8. This tells us that their customers are paying them debtor days within 121 days. They're paying their creditors within 101 days, and they're churning their inventory every 35 days. And we would typically buy a company on a cash-free, debt-free basis. So on completion, they take the cash, they pay off any short-term debt, so we get an unencumbered balance sheet, and we can adjust the working capital for that as well, which in this case suggests that the working capital is 867k. What we always say is that whilst we're buying a cash-free, debt-free basis, we do expect the company to be sold and delivered to us with normalised working capital, so they don't just empty the bank account completely of cash, because the day after completion, what will happen to checks they've written on the account or direct debits that need to be paid. So we will work out when we get to the deal structure what we think normalised working capital will be and how much of the cash needs to stay in the bank account to cover that, and we'll have that conversation with the business owner. We can then analyse how we're going to do the deal. So there's 3-year average EBIT and EBITDA. Are we going to use the latest? Well, in this scenario, we're going to use the latest EBIT because profits have declined. They've gone from 2 point something down to 1.2. So we're going to use the most recent EBIT of 1.2. We're going to pay a 2 times multiple, which values the goodwill at 2.5. So 1.2 times 2 is 2.5. We've got the adjusted net asset figure of 3.7, gives us a total purchase price, adding those together, of 6.2. We can pay 4.4 at closing. I'll show you where we've come up with that figure in a moment, which means there's 1.8 million for us to pay on a seller note on a deferred basis, which we're going to do over 5 years. So essentially that's equivalent to a multiple of 4.9. So 6.2 million divided by 1.2 is 4.9. How we're going to fund the deal. So they've got aged receivables of 2.5 million. We can fund 80% of that, but they do, in this scenario, already have existing funding that we would need to knock off. So that gives us 2 million. They've got real estate, so we're going to borrow against that. They've got plant and machinery. We're going to borrow against that. Cash is basically needed for working capital. They've got some small bank loans that need to be repaid, so that's why those figures are in there as a minus. There's going to be fees, so this is lawyers, professional fees, deal fee maybe for yourself, also arrangement fees with lenders and all that sort of stuff. We're going to pay off the 100 grand's worth of existing finance, which is this here, which leaves 4.4 million left over. We can then see what this is going to cost us. So invoice finance is going to cost us 221 grand in interest. The real estate is going to cost us 30 grand in interest and 19 grand in capital repayments every year. Plant and machinery is going to cost us 182k in interest and 455 a year. And the deferred note of 1.8 million is payable over 5 years, which is 366k. So all of that totals 1.275. So we've got total debt servicing of 1.275 against EBITDA of 1.5. So within the realms of where we need to be to service the transaction. So that's a very basic way how we analyse the deals. Let me go back into the slides. So we've now got a ballpark idea as to where we think we will be. So what we would then do is arrange a call with the business owner, and we would have a conversation with them to say, look, we've analysed the deal. We'd probably share that spreadsheet. We give them the sort of logic behind the deal. So it's not just about giving them the actual deal itself. We're actually explaining, this is the profit figure we've used. This is the multiple we're applying. These are the assets that we are acquiring and their liabilities. This is the working capital position. And that's how we've come up with the deal. We're explaining that the future cash flows of the business have got to service this debt. They've also got to service their seller note. So in other words, if they want to negotiate and say, look, I want more upfront, or I want, to be paid quicker, well, we can't really do any of those things because the cash flow is the cash flow. In that business, there was 1.5 million of EBITDA, which essentially is what the free cash flow is. Out of that, you've got to pay tax, you've got to pay the debt. You've got to have some left over for capital expenditure. So we have all of that conversation. Maybe there's a little bit of negotiation and tweaking to do. When we get them to a point where, we're there or thereabouts, what we then do go away and do a much more detailed financial model where essentially we take exactly the same process, but we just basically build a three-way model. So, it's typically looks back 2 years and goes forward maybe 4 or 5, and it's a monthly P&L, it's a monthly balance sheet, and it's a monthly cash flow, and it enables us to sensitize that model so we can sort of do scenarios. What if we lose a major customer? What if revenue declines? What if margins decline? What if payroll costs go up? So that we can sort of see what sort of best case, worst case, actual case we think is going to look like. So before we make a formal proposal, we've done all of that analysis, and 99% of the time it's going to be broadly in line with the sort of ballpark idea that we've already proposed to them. So when we make the offer proposal, we actually do this in a professional way. So typically we'll do it on Zoom, and you can obviously meet them face to face, but we'll pull up some slides, we'll do the screen share. And the key messages that you want to deliver to them is that you want to sell our expertise, your expertise from an industry and M&A perspective, that you're a safe buyer, you're not going to fire the staff, you're not going to change the name, you're really about building upon their legacy. You can talk about either your track record if you have one, or if you're joint venturing with somebody, what they've done, talk about the plans for the future, and you can then get into the financial and legal structure so that they can see how you form the proposal. So let me show you an example of the deck. I'm not going to go through this in like mega detail, but essentially this is a professional slide deck. Proposal to acquire their company. So you maybe put their logo there. Today's agenda: we're going to talk you through the proposal to acquire your company. We're going to go through our experience, process, the legal and deal structure, what our focus will be, the financial components of the proposal. If there's a real estate element where we're going to be creative with it, then maybe we'll include a section on that, because we need to explain that. But obviously, if it's not relevant, then we take that out. We highlight our experience, so what we've done before. If we've got specific sector experience, then we can talk to them about specific companies that we may have been involved in or are involved in. We can talk about the key people in the deal team. So obviously, in my case, I talk about some of the key people, our side and operational team members. Obviously, you would include yourself here. We then talk them through the process. So if we get to an agreement today, we then agree the term sheet. The term sheet is the roadmap, really, where it sort of records in 4 or 5 pages what the deal looks like and the key terms and conditions. We then run due diligence, so we explain what that looks like. We do the financial modelling, we go through the legal process, we raise the funding, we get to a completion, and typically that takes 3 to 4 months. We talk about communications plans, so it's really about business as usual, making sure staff, customers, suppliers, funders, landlords are all comfortable. So we talk about what that looks like on day one, what the first 30 days look like, what the handover period sort of looks like for them. We remind them about the SPV structure that we spoke about before. We talk about what we're going to do with the company. So some of the plans, this can be quite specific or it can be more general. In my presentation, I've got actual video testimonials that I can play them, or I'll send them these slides after the call, and they can obviously click on the links and listen to them. But there's a business owner that sold to us and speaks positively, and there's somebody that's done multiple deals with us that speaks positively. There's 2 staff reviews. So they actually went through a takeover of where we became the new owners, and they again talk positively about what happened to the business, and all of that obviously adds credibility and backs things up. If you were joint venturing with me, obviously you can have access to all of these case studies and credibility. I've written books and all sorts of stuff. We then talk them through the deal structure. So we explain, the sort of assumptions and metrics that we've used. So what EBITDA, is it an average? Is it the latest? What the balance sheet's worth, the normalizations that we use. We explain the structure in terms of debt. We then talk about the financial proposal. So we're going to purchase the business for whatever, and that's going to be broken down as how much on closing, how much deferred over what period of time. If there's an earn out, we're explaining how that works. If there's a real estate element, so maybe if we're doing like a sale and lease back, for example, then we can explain how all of that works and how that forms part of the structure. Obviously, if they don't own any premises and it's not relevant, that part of the presentation will be removed. And then we have the questions and next steps, which essentially is, they probably may give you some feedback there and then, but most of the time they want to go away, digest, and then they'll probably come back and want to negotiate something with you. But it's just a really proper professional presentation that we find presenting it in that way really helps. So let me go back into the main slide deck. So after some negotiation, we hopefully get to a term sheet. So I describe the term sheet as the roadmap. It's a 4 or 5 page document. It's a non-binding document in the main. There are some binding sections, which I'll explain when we get to it. And essentially, it's a piece of paper that sort of records, the key terms and conditions, the purchase price, the deal structure, and we hand that over to the lawyers, and then they use that to build the more detailed legal contracts. So let me show you an example of a term sheet. So this is the term sheet. So let me explain this as if I explain it to a business owner. So this is a non-binding, or in the main, non-binding term sheet. It acts as a roadmap for us to get the deal done. There are some binding sections, which I'll explain in detail when we get to those sections, but essentially they're confidentiality, exclusivity, fees, and governing law. So we put the company details. This is the company we wish to buy. Sellers are detailed here, so the names of all the shareholders. Purchaser is going to be a newly incorporated SPV. We explain what the SPV is. Then we have the consideration. So the total purchase price is whatever. We're going to pay this at closing, and we're going to pay this on a deferred basis over a period of time in whatever installments. If there's an earn-out, then we'll explain what that is and how it's calculated. We then talk about funding. So the initial consideration is made up of new debt injected into the balance sheet of the company, with the company being used as collateral for that debt, and we can be specific about what that debt is. If there's surplus cash, then we'd include that and explain how that works, and by including the cash is more tax efficient in this structure than taking out as a pre-completion dividend. If we're offering any sort of guarantees, then that will be here, which is really around security. We'll talk about security separately. Service agreements. So, the seller is going to enter into an employment or service agreement to enable the business to be sort of handed over, and we can maybe map out the terms of that. So 12 months for whatever. Key terms and conditions of the sale and purchase agreement. So, there'll be custom sort of warranties and representations in the main contract. Any conditions to completion. So satisfactory due diligence, no material difference in the financial performance of the company, execution of the service agreements between the company and the key identified management. So mainly the seller. Receipt of final approval from the board of directors of the purchaser, and receipt of any corporate or third-party approval. So we might discover in due diligence, maybe there's change of control clauses, particularly that tends to be in leases or any external funding. So we might need to seek permission of those third parties for completion to take place. Sometimes we'll get them before completion. Sometimes we'll complete and then we'll get them after. It really depends on the level of risk. Due diligence. So after we sign the term sheet, we'll issue them with a checklist, which gives them all of the sort of list of information that we need. They can populate a data room, which we'll set up for them. We'll review it. We'll go back with them with questions and queries, and ultimately satisfy ourselves that we're comfortable to proceed. Confidentiality is a binding clause, so essentially it says we're going to share info, they're going to share info. We agree to keep it between ourselves and our professional advisors and not share it outside of that. Exclusivity. So typically we ask for an exclusivity period of between 5 and 6 months. What we say here is that there's quite a lot of work and effort that goes into putting these transactions together. And what we don't want to do is start doing all of that work, incurring those costs for them to go and sell it to somebody else in a couple of months' time. So the period of exclusivity enables us to do the due diligence, have a fair crack at the whip of getting the deal over the line, and they agree not to sell the company elsewhere. And we are both going to incur fees in the transaction. They agree to pay theirs, we agree to pay ours, and then this is running law, is obviously the law of the country in which you're doing the deal, UK, Australia, whatever. Signed date, And then we just put a proposed timescale in the appendix, sort of, key milestones to be achieved. So, due diligence checklist can be issued within a day of the term sheet being signed. We'd aim for maybe 4 to 6 weeks for round one of DD to be done, DD to be completed within 6 to 8 weeks. Draft sale and purchase contracts probably be issued within month two of this being signed, because some of the warranties might be specific to due diligence, so we don't issue that until we've actually done some of the due diligence. We expect them to turn it around then probably within a couple of weeks with their lawyer. And we sort of, after legal negotiations, maybe we agree that within 3 months. So completion can take place month three, maybe month four, signing that, which is well within the exclusivity period. Sometimes we might negotiate the exclusivity period down to 90 days if we think it's a fairly straightforward transaction, but you just have to take a view on that. So that's the term sheet that we use. And it's also quite useful as well that if you end up where maybe later on the business owner or their lawyers want to start unpicking things that have already been agreed as part of that term sheet, you can say, well, look, I don't know why we're arguing about this, because we've already agreed this in the term sheet. So let me go back into the slides. So I think now is probably a good time to pause. Let's have a 10-minute break. It's 26 minutes past 9. So if you want to come back for 25 to 10, so 10 minutes time, and then we'll pick up on what happens once the term sheet's signed. We'll talk through the due diligence, and then we'll sort of talk through the legal fundraising process, and then what we do with the company post transaction. So yeah, let's have a 10-minute comfort break. I'll see you all back here in 10 minutes. So up to now, we've hopefully now got our term sheet agreed. What we'd now do is issue a due diligence checklist. Due diligence really covers commercial, legal, financial. I'm going to show you an example of what that checklist looks like. And really what we're looking to do is not to use this as a process to try and chip the price or renegotiate in any way, shape or form. Generally, it's to satisfy ourselves that we're happy to proceed on the terms that we've agreed. If there was anything that we were concerned about that was enough to put us off the deal, then obviously we'd walk away. But it's really to try and identify the key risks, and then we can mitigate against those. So I'll give you an example in a moment. But essentially, we're looking for any impending or existing litigation that could cost the company money. We're looking at the financial performance of the business. So, any customer concentration issues, customers they might lose. If there's any anomalies in the financials that need explaining, we're understanding the business operating model, that it can be scaled, and we're looking at the key people within the business and obviously the reliance on them. So a real simple one would be, let's say we look at their aged receivables and we can see that one of their customers hasn't paid their invoice for 6 months, so potentially has the risk to turn into a bad debt. Maybe that customer is going to go bust, or they're not going to pay the bill. It's not recoverable. What we might do is build into the actual legal contract, so the SPA, an indemnity that says, look, if customer XYZ fails to pay their bill within this period of time, you agree to reimburse us by that said sum and indemnify us for that, and maybe that's then knocked off the deferred consideration. That would be a very simple thing. So something like that would not concern us. If they were facing some significant litigation and that wasn't covered by insurance, then that would be probably a fundamental risk that we wouldn't be able to protect and would probably cause us to walk away. So let me show you an example of a due diligence report. Sorry, due diligence checklist even. So this is quite small. Let me zoom in. So essentially what we have here is name of the company. We index everything by number. So when we create the data room, we create folders. So folder number 1 is called financial. Folder number 2 is legal and company constitution, with each of these sub-indexed, and then they would just basically upload the documents that we ask for. So for example, full accounts for the last 3 years, management accounts for the last financial year, age debtors report, age creditors report, forecasts, external bank funding, etc., bank account statements for the last 12 months, trial balance. Legal and company constitution, so copies of share certificates, memorandums of incorporation certificates, shareholders agreements if applicable, resolutions passed in the past 5 years, board minutes for the past 3. Legal documentation regarding company trading, so any material agreements between suppliers and customers, standard terms and conditions, any consulting partnership framework agreements, marketing material used in the business, copies of insurance policies and schedules, copies of any licenses or certifications, property, so details of any leases or property that they own, confirmation that they own the website and the domain names used in the business, HR, so employment contracts for staff, self-employed contracts, any employees that are no longer employed, details of any software, intellectual property, things, tax, so last 3 years tax returns, last 5 quarters VAT returns, last payroll report, screenshot of the HMRC portal showing corporation tax, VAT, PAYE, etc., being all up to date. Obviously, this is a UK deal, so this is talking specifically about UK. I'll show you an example of an Australian one in a moment, and then general other SWOT analysis, energy costs, and then we ask them to fill in more detailed information. So auditors, tax advisors, company secretary, legal. We ask them to fill in details of their insurances, key holders, bank access, signatories, etc., etc. And we then have operational questions which really sort of revolve around sort of how the business operates. So what we would then do is when we review each of these documents, we would then make any comments or questions in here, so queries round 1, and then they would then provide their responses. So it records everything in this spreadsheet, and that then either makes us comfortable or not. So for example, one of the queries here is we noted that the audited accounts exclude the corporate tax payments for years 22, 23, 24. Would you be able to clarify how much the company paid in corporation tax during these years? And then number 2, they've answered here to say that will be providing additional information folder in the Dropbox, and then they explain what the file name is recorded. We then highlight this yellow or red, or green. So green means that we're satisfied, no further review required. Yellow is that we're actually outstanding something, so it's still pending. And if it's red, then it means that we need to do something to mitigate the risk. So that's probably building something into the eventual SPA. So let me just give you an example of an Australian due diligence checklist. It looks very similar, to be honest. Here we go. So exactly the same, financial accounts, creditors, debtors. The legal bit is slightly different. So we'd need details of the share capital, directors, ASIC register, and the tax bit is a bit different. So we ask for their ATO client statement, the BAS for 12 months, payroll tax again, and details of any ATO payment arrangements. So pretty much the same with just those differences in sort of terminology, really, but essentially we're looking at exactly the same stuff. So let me go back into the slides. So fundraising then. So what I would always recommend before, and most people do this the other way around, by the way, is that when you want to raise funding, you typically go and find the deal, you do all the analysis, you structure things, you get the deal agreed, and then once you've got a signed term sheet, you then go and talk to the banks. That's actually the wrong way around to do it. What you want to do is, look, if you're going to go and do some acquisitions and buy and build in your industry of specialism, I would go and build links with lenders that specialize in asset-based funding and are open to doing transactions in your industry. And essentially you would identify the business development manager within that organization. You contact them, you'd explain who you are, you're looking to make acquisitions, you're a bit of business investor, and you want to understand, as and when you get a deal, whether they have an appetite to lend into that particular industry on a leverage buyout type structure. And you can ask them a ton of questions. So essentially, you're interviewing them, and you're also using that then to build up the relationship. I actually wrote a book that's called Buy It With Debt, and I'll show you the books that I've written towards the end of this webinar today. But in that, we get into a lot of detail around how you would approach the process. So how you look for the banks that will fund these deals, how you approach them, what you say, how you get the credibility, and ultimately how you get these things funded. So well worth a read if you want to dive into more detail. So we're not going to get into that level of detail in this webinar today. That's probably a whole a different session in itself. But essentially what we want to do is we want to present the due diligence to the lender. We want to produce the business plan to the lender. We want to demonstrate the financial model. We want to demonstrate that we've shown through different scenarios, what if things get better, what if things get worse, what if we lose a major customer, what if margins decline, what if payroll costs go up. So that really is going to give the lender comfort that they know that even if some of those things happen, that they're going to still get repaid. Fundamentally, that's what the lender is concerned about. So we would basically package this up and present it to lenders. We've obviously built relationships with funders across the globe. We have asset-based lenders pretty much for any form of asset class in the countries in which we've operated. So that includes US, Canada, United Kingdom, Australia, New Zealand, invoice finance, real estate, sale and leaseback funds, investment funds. But we also have our own network of investors. So we have around about 900 private investors, high net worths, that we can potentially tap up for equity into transactions. So if you were joint venturing with us, obviously you get access to all of that ability to raise funding. As I said, we the last deal that we completed about 3 or 4 weeks ago was a 50 million revenue manufacturing business, completely funded by invoice finance and seller finance, 3 million, 3.2 million of EBITDA without any equity whatsoever going in. The deal that we did prior to that was a construction services business in Australia, again, completely funded with no equity, all came from invoice finance and a seller note, and the sellers actually in that scenario rolled over a small amount of equity. Typically, we'll try and get 3 to 4 offers so that we can not necessarily play one off against the other, but it enables us to negotiate. So sometimes cheapest isn't always best. It might be that some are offering more flexible lending conditions or covenants than maybe the next lender. Of course, there's finance brokers out there as well that you can go to, but they tend to be typically quite expensive. If this is your first rodeo, I'd probably recommend building a relationship with a broker that really understands the market, that can do a lot of the legwork for you, but be prepared to pay probably 100 grand plus on a contingent basis. So you only pay them if the deal happens. And again, you raise enough money from the bank to not just pay the seller, but also to pay the broker. That they will essentially, you're buying their relationships and their ability to do these sorts of transactions. Like most brokers, it tends to be alien, the whole concept of not putting any of your own money in, and it's a bit of an education exercise. But there are brokers out there that fully understand the no money down LBO type structure. As I say, you can go directly to lenders, but I'd recommend read my book, which will explain exactly how you would approach that process. So I'm going to show you very quickly an example of a credit-backed offer. So this was a deal I did quite a few years ago, but same principles apply. So here's a credit-backed offer. So basically, the lenders looked at the business plan, they've looked at the financial model, they've looked at everything that they need to look at to be comfortable. And here is a credit-approved offer. So this is invoice finance. So they're going to give us an invoice finance facility limited to 500k. They're going to advance 85% approved debts. You can see all the sort of costs in there. They're going to give us a cash flow loan of 250 grand over 36 months. And they're also going to do plant and machinery loan over 5 years. That's essentially where we want to get to. And typically that process, once you've got all your information together, probably takes about three to 4 weeks to get to that point. So we'll go back into slides. So legal process. So the legal process is fairly straightforward and similar in most of the jurisdictions that we operate. Obviously, there are different laws, although they tend to be fairly similar. But the same sorts of suite of documents are put together. They might be referred to as slightly different things depending on where you're operating and doing deals. So, for example, in the UK, we might call, when we get to a day of taking over the company, we call that completion. But in Australia, it's generally referred to as settlement, for example. And there are legal nuances. So, in the United States, for example, there's 52 states, and they've all got different tax rules and maybe different laws we need to be mindful of. If you're pursuing deals in the United States, again, I would recommend probably going for business-friendly states and maybe just pick 2 or 3 that you could really understand rather than chasing deals nationally. So, for example, California is quite a difficult state to do transactions in my experience. It's very litigious. People sue each other a lot, and it's also not necessarily the most tax friendly. Whereas there are more friendly states like Nevada, like Colorado, for example, where we have done transactions before, and it's fairly straightforward. So the main document is the contract, often referred to as the SPA, or the sale and purchase agreement. This can be an agreement that can stretch to 100 plus pages. And there are then ancillary documents that accompany that. So that could be board minutes for the buyer, board minutes for the seller, stock transfer forms, share transfer forms, consultancy agreements for sellers that are staying on in a handover period. There's quite a lot of documents that typically we see in a transaction. So let me give you an example. So this is a UK-based deal, but this is an example of the documents that we would need. So share purchase agreement, disclosure letter. We'll talk about disclosure as we go through the legal process in this presentation. Stock transfer form, share certificates, indemnities for lost share certificates, power of attorney if applicable, letters of resignation of the current directors, letters of resignation of accountant, completion board minutes for buyer, seller, company, person of significant control letters, various company house filings, consultancy agreement, debenture, share charge, etc., etc. So this says who's going to be responsible for doing it, the lawyer for the seller or the buyer, and obviously it gets ticked off when it's done. So fairly comprehensive bundle of documents. Let me share with you an example of an SPA. So as you can see here, this is a fairly comprehensive document. I think it goes to 107 pages. So we've got the name of the company we wish the name of the seller. We've then got the SPV details. We've then got the background and all of the definitions, which the definitions themselves run to several pages. Construction of the contract, sale and purchase, the purchase price, how it's being calculated and structured, the right to set off against the deferred. So, if we make a warranty claim, we have the ability to set off or essentially reduce the amount of the deferred payment until the warranty claim is resolved. Obviously, this is deal specific. Completion obligations, completion accounts, the warranties that we're seeking, and how the limitation on those warranty claims are in place, any property matters, covenant, indemnities, restrictions on the seller. So we'd probably ask them to not compete with us or take away customers or anything else within 3 years of taking over. Obviously, you don't want to buy a business and then find they set up in competition the next day. Confidentiality section, assignments, notices, third-party rights, counterparts, governing law. Then you've then got details of seller's obligations at completion, completion board minutes, the warranties. So these are all of the warranties that we're seeking. So this does reduce due diligence quite significantly if there's a warranty. They basically have a disclosure process. So, for example, one of the warranties may be we say that they're not aware of any bad debts within the business, but they might make a disclosure to say, well, customer ABC owes us this amount of money. This is their invoice. It's been unpaid for 4 months. It isn't a bad debt, but could be. They are then disclosing that under the warranty. So essentially, any warranties they can't give, as long as they make a disclosure, we couldn't then claim against them because they've made us aware of the problem. But if they give us a warranty and don't tell us about a potential problem, then that gives us cause to potentially claim against them under the warranties. There's exactly the same warranties for tax as well, but obviously all tax specific. You tend to find in SPAs that the warranties tend to be time limited, maybe for 2 to 3 years. So general claims, the tax tends to be 7 years because tax authorities typically, if they go and do an audit for you, they'll probably go and look at the last 7 years. So we typically say that general warranties are capped at 3 years, so we can make a claim at any point in 3 years. But if we want to make a claim against any of the tax warranties, then that might be 7 years. Again, that's all open to negotiation, but they're the typical sort of timescales that we typically tend to see. Obviously, these are fairly extensive warranties, as you can see. So yeah, very, very, very comprehensive document designed to protect both parties. Let's go back into the slides. So we touched on warranties there. So essentially what a warranty is effectively an assurance of the state of affairs. They have the right to, they are expected to disclose against those warranties. So another example could be, let's say one of the warranties are not aware of any pending insurance claims. But let's say that maybe they had a personal member of staff that incurred an injury on site, and there is currently a pending insurance claim in regards to this matter. What they would do in the disclosure letter is, regarding warranty number whatever, regarding no pending insurance claims, we are actually making a disclosure that such and such a member of staff was injured, and then they explain all the scenario and the current status of the claim. If that then cost the company money, wasn't covered by insurance, we can't go and claim against them because they've made us aware of it. We need to get comfortable with their disclosures. Indemnities are different in that essentially they're a promise to reimburse the indemnity holder, so us, really the buyer, in respect of the future liability. So, for example, going back to that bad debt scenario, let's say we discover that they've got an unpaid invoice that could turn into a bad debt. What we might say is we might ask for an indemnity to say, look, if this customer doesn't pay us within 6 months of taking over, if it turns into a bad debt, you agree to indemnify us against that. And usually there's a mechanism to enable us to reduce the deferred consideration by whatever that sum is. Recommendations for the legal process would be, I think, there is always a risk that lawyers can get carried away with themselves. So it's very important to create a weekly stakeholder call. So this is usually attended by buyer, seller, both sets of lawyers, any corporate advisors, and then as you progress through the process, you might bring the funder in later on in the process. And really the purpose of that meeting is to make progress. So it might only last 5 minutes, it might last half an hour, it might last an hour. It really depends on where you're up to in the process and actions agreed. So really what we want to do is every single week agree some actions, then the following week we check that those actions have been undertaken and that we've made progress. And then if there are any contentious issues, you all come together as a collective. So it's not just reliant on lawyers, where you can talk directly to seller, buyer, advisors, and try and address any contentious sort of issues. Most of the contentious issues, in my experience, tend to fall around warranties, not so much about not giving them, but more about qualification, time limits, which is why we tend to agree all of those things in the term sheet. And then also around protection. So, essentially the risk to the seller is that they've got a seller note, so they're owed some money deferred. and they might not get paid that for whatever reason. So generally there can be protections that are built into the contract that says for as long as that amount is outstanding, you can't do any of these key things, because that's to protect the seller. So for example, they might restrict dividends to a certain level. They might say you can't sell off assets other than in the ordinary course of business. They might cap capital expenditure at a certain level. And all of those things are open to discussion and negotiations. They've got to be reasonable and fair. And I say you can't have your hands tied behind your back when trying to run the company, and they need to understand our position that we're going to want to invest to grow the business whilst being respectful to the seller, that they're not going to want us to be able to have carte blanche to do what we want until ultimately they've been paid. And essentially, we're giving them the same sort of protection as the bank, really, in terms of the funding, that they're not going to we're not going to do certain things as long as we owe them money. Very similar protections to the that you'll give to the bank. So let's talk about security. So this is something that's probably addressed earlier on in the process. So when you are probably negotiating in the offer, you're doing the term sheet, the seller might want to ask about what guarantees you're going to give. So I wouldn't necessarily offer all of these things in one go, but these are all the different types of security that you can potentially offer. You can offer them all, or you can just offer one or two of them. So a share charge is a charge over the shares in the company, and that gives them a very easy mechanism to take back control. So in the event of a default, you don't pay them when you're supposed to pay them. They can essentially just take back the shares, take back ownership of the company, and pick up where they left off. It avoids any sort of insolvency process to achieve the same outcome, which is where the debenture would come in. It just means that you agree what events of default would be. So I would say probably it's not on the day the payment is due. If you don't pay, they can take back control. It's probably if you're in default by 2 or 3 months, or maybe 30 days, or something like that. Is probably more reasonable. A debenture is the security against the actual company itself, and essentially what that enables the seller to do in the event of a default is to force an insolvency event, so the company can be wound up or sold, and any assets that are liquidated then go towards paying them in terms of whatever may be outstanding. Typically, absolutely 100% of the time, the debenture will always be in play for the lender as first charge. So whoever you fund the transaction with, invoice finance, real estate funding, whatever, they're going to have a debenture over the company. So the seller can have a debenture as well, but it would always be subordinated. So it would be second ranking to the bank. So it doesn't give them the same level of security. One way of overcoming that would be to say, well, just because they're not the first charge holder, and the bank obviously is, essentially they're getting the same protection as the bank, because the bank has got the security over the company. So whatever you've got to do to comply with making sure you're not in default of that funding, essentially the seller's benefiting from that as well. So whatever the covenants are, restrictions, etc. This is why you then potentially offer them a share charge, because if they don't deem their second ranking debenture as enough security, well, giving them the ability to just take back control if they wanted to can be a far more straightforward process for them. The other thing that you can offer would be actual protections in the contract itself. So you could limit dividends and distributions during the period that you owe them money. So I wouldn't say no dividends. I'd probably cap it at a certain level, or certain conditions need to be met to be able to be paying dividends. So their deferred is up to date. There's no default. We're trading within the bank covenants, for example. Not incurring capital expenditure above a certain level. As part of your due diligence, you'll understand what the capital expenditure requirements are of the company. So whatever they are, I would say is probably where the cap needs to be. So you're not going to spend more than you need to maintain the business. And then there could be other things in there as well, like sharing regular management accounts, just like you're going to have to do with the bank, or holding quarterly meetings with the seller. There are all sorts of things that you can build into the contract, and are all basically part of negotiation. As I mentioned, the contentious areas typically tend to be warranties and indemnities. Either the actual warranty itself, well, they've got the disclosure, so they shouldn't be arguing about not being able to give a warranty. If they're aware of something that is an issue, then they should be disclosing it. And if they fail to disclose it, then you've got the protection of that warranty. Limits, so the amount per claim and the timescales for those claims. So this is why we try and lock those down in the term sheet. So, if they're trying to reduce them later on, we can say, well, look, we're arguing about a point and we've already agreed. So typically we're going to say general warranties are 2 to 3 years. I think that's a pretty reasonable timescale. During that time, you're going to flush out any issues and be able to make any warranty claims during that period of time. And if you've got the right to set off against a deferred, probably most of the time you're going to be paying the deferred off within 3 or 4 years. So if you extend the time limit beyond that, and then you end up paying them all of the deferred, but then make a warranty claim later on, it's more difficult to collect than being able to just offset it against the deferred. And sometimes they'll put quite hefty limits. They might say, well, you can't make a warranty claim unless it's going to be more than 50 grand. So, if something's going to cost the company, say 50,000 or more, you can make a claim, but anything less than that is zero. Again, we lock in those limits into the term sheet. Typically, we'd probably say 5 grand, and that's pretty fair. Lawyers will always on the other side argue for 20, 25 or more. But 5 grand is pretty standard. The right to offset can also be a contentious area. So, most lawyers on the sell side will always argue against that. My argument is that, look, if you have a contract that doesn't allow you to offset, but you then want to raise a warranty claim, you're probably going to just stop paying the deferred anyway because of the issue that you've discovered. So actually having the right to offset enables you to have a fair process to determine whether the warranty claim is valid or not. So typically that might be that, you've got 90, you make the warranty claim, you set off against deferred, you then have 90 days to negotiate and agree between the parties. If they can't, it then goes to maybe arbitration, and whatever the arbitrator says is final, and either your warranty claim is accepted or it's not, or if it goes to court, obviously whatever the judgment may be. I would always say about any form of litigation that it costs time, effort and money, and it can be an unnecessary distraction. So due diligence is really key to trying to understand the business, so that hopefully you're not ever having to make any sort of warranty claim. Far better to go in with your eyes open. So I'm not saying it doesn't happen, but if you do your due diligence right, you should really be flushing out any issues as part of the process prior to you actually becoming the owner. Because if you have to make a warranty claim, it can cost 50, 100 grand or more even to take it all the way. And it becomes an unnecessary distraction. So it's always better to try and resolve these things informally, which is why it's important to have a relationship with the seller, not just to get the deal done, but during the period of deferred, that look, if there are any issues, you've hopefully got a good enough relationship to be able to reason with them, to negotiate and maybe try and agree something. The other contentious areas can be around security and the protections, so the level of protections. The seller's always going to say, you can't do any of these things, and you're going to say, I want to do all of those things, and it's trying to find the balance between the two. Non-compete tends to be more lawyers just lawyering about. So look, if these sellers are older, retiring, it's highly unlikely they're looking to go and compete with you. So asking them to enter into a 3-year non-compete, if you're multi-millions for a company, you don't want them setting them in competition in 6 months' time or taking away customers or staff into some sort of new venture. So I think 3 years is pretty standard. They'll all argue that it's not fair, it's too long. But look, if the seller's got no intentions, then it shouldn't be an issue. So let's talk about, before we get into growth post-acquisition, I think there's quite a lot of obviously time, effort and money that goes into putting these transactions together. So in terms of sort of fees and things that you can expect, generally we won't be incurring any fees whatsoever up front. These will all be loaded into deals. So when you raise the money from the bank to do the transaction, not only are you raising enough money to pay the seller whatever the down payment is, you're also raising enough money to pay all of your professional fees. So lawyers, accountants, arrangement fees, broker fees, lender fees, etc. And we all build them into the financial model. If you're working with us, we do have relationships with lawyers, accountants, and all the professionals that we need to get these deals done. They'll all work on a fixed fee basis. They'll all work on a contingent basis. So we only pay them if the deal happens. I guess we've built up that goodwill with them over a number of years to be able to get to that position. Because they know that we do multiple deals, there's quite a lot of business in it for them. And it's rare for a deal to fall through from signing a term sheet. So, they don't want to end up doing a load of work they're not going to get paid for. So if you work with us, then, again, that's another, I suppose, benefit of what we bring to the table. Lawyers, depending on the size of the transaction, in pounds, would probably charge somewhere in the region of about, between 15 and 30 grand if it's a really large, complex, multiple company acquisition. The higher end, if it's a one owner operated, simple company, probably the lower end. So in Aussie dollars, that's roughly somewhere between $30,000 and $60,000 in terms of sort of costs. Accountants, we have the resource in house, so generally we won't be going to external accountants for anything. But if we were to do so, you're probably looking at £3,000 to £5,000. $5,000 to $10,000. For lender fees, typically they tend to be built into the loan itself. So arrangement fees can be anywhere between 10 and 50 grand. If you're using an external broker, it's a complex transaction, you could be looking at 100 grand plus. So it would be better to work with somebody that's already got those relationships, I suppose, and understands the whole fundraising process. Yeah, quite a lot of time and effort goes into it. It probably takes over your life the week or so before completion, because basically you're aligning everybody, we're finalising the legals, and the fund has got to do their final checks on the business. So you have to talk to lenders, lawyers, other external parties, seller, buyer, and there's quite a lot to do as we move to completion. To make it simple, what we try and do is we try and line everything up the day before. So we make sure the lender sends funds to the lawyer's escrow account so they can be released on the day of completion, and they send the funds the day before. We make sure that all the legals are agreed and signed and held to order the day before. So on the day of completion, it's quite simply just a phone call between the lawyers to say, yes, we hold signed copies, we exchange those copies of documents and contracts, and we confirm to the lenders that all the conditions have been met, and then formal completion can take place. So almost completion day can be a bit of an anti-climax. But what we'll agree with the seller is that we're going to be probably on site the day of completion or the day after, and really it's about a message of continuity. It's the same management running the business. We're not here to change things. Reassure people, reassure stakeholders, staff, customers, suppliers, landlords, any funders, etc. That just because there's been a change of ownership, it's still very much business as usual. So you might think up until this point there's obviously quite a lot of time, effort that's gone into doing the transaction, and of course there has, but I always say that the easy part is to actually find and do the deal. The hard part is actually when you take over the company, because you're taking over a company that you have no experience of running. If you've done your due diligence, you're going to hopefully go in with your eyes open. If the owner's succession plan, then there's going to be a capable leadership team in place. All of those things mitigate any sort of risks of things going awry. But really your job is to now grow this business that you've bought. We're not here to stand still. So some of the key things that we'll look at is firstly top line growth. So how do we get more revenue in? What you find with a lot of these sort of family owned businesses is that they've built their business over many years. Most of it's word of mouth, recommendations, referrals. They tend to have long standing customer relationship. What they don't have is proactive sales and marketing, and they can be things that you can potentially do to improve the business. Bottom line, so it's just reviewing the cost base. It's not uncommon for them to work with the same supplier or insurance broker or whoever, who might be a family friend for many years, but that doesn't necessarily mean that they're getting the best deal. So there might be areas that you could look to save cost on. We're looking at all of the costs. So, is it needed? If it is, can we get it cheaper? Cheapest isn't always best. It could be that, there are better value solutions out there. There are clever financial re-engineering tricks that can be used that ultimately can release cash flow. So various different structures Again, we could do a whole webinar on that. We're not going to get into the detail of that, but there's several things that you could do. So simple things like improving the credit control process so that you get your customers paying you quicker. Stretching creditor days a little bit, putting a more automated inventory process in place so you're buying stuff in real time rather than sitting on hoards of stock. All of those things, just moving the dial by 2 or 3 days can potentially, in most businesses, release six figures. Selling off any assets that aren't needed. I took over a construction business where they had a fleet of vans, and we found that 3 were just parked, and we didn't have staff that needed them or used them. They were just sitting idle, so we sold them. Obsolete stock. If there's any stock that the business has got that isn't used, is obsolete, could you sell off that stock somewhere? So let me show you a sort of quick checklist that we send in. Find it. Okay, sorry, just needed to find it. Here we go. Zoom in. Yeah, so I mean, this is initially we've got the item of the checklist. Who's going to lead that process? If there's anybody else involved on the team, and when we're going to actually do it by. So on day one, clearly the MD needs to meet with all staff and sort of explain what's happened and message of reassurance, and make sure that there's a written communication issue towards staff, particularly if there's any that are not present or on different sites or working away or on holiday or whatever. And then, so this is a sort of 90-day plan. So HR audit, HR questionnaire, one-to-one with staff, finance, so getting on the bank mandate, getting access to their accounting software. If you're using an invoice finance, making sure that's all implemented properly, making sure there's an authorization process in place for any expenditure, making sure that the credit control process is updated to being best in class, making sure that we understand the payroll process, updating contact details with the tax authorities, reviewing sales ledgers, purchase ledgers, meet with all of the key stakeholders in the first sort of 60 days. So suppliers, customers, landlords, external funders, accountants, auditors, legal, making sure obviously everything's filed appropriately at Companies House. Most of the time the lawyers take care of all of those sorts of things, but you want to make sure that those things happen. Sitting down with the MD and making sure that we refine the business plan, we refine the financial model based on our first 90 days, logins for all of the sort of key things that they use, and then sort of general things. So I wouldn't say it's a big extensive list, but they're the sort of core ones that we typically tend to look at when we take over a business. So let me go back to the slides. Okay, so just a quick word on people. When you acquire the business, my recommendation would be only to buy a business where there's a capable management team in place. It's not reliant on the owner. It's not reliant on one person, and either there is an MD in place that's not the owner, or they've identified somebody that's capable. So maybe it's, I don't know, the operations director that's going to step up. That really just mitigates the risk of things going awry, that you've got somebody capable running the day-to-day, can deal with staff, customers, etc. Clearly running one business versus running a group of 4 or 5 companies that you might end up acquiring and putting together over a period of time will take a different skill set. It takes a certain type of person to be able to run a 5 million revenue company to one that might be running 100 million revenue group of companies. So as you go, you might need to bring new expertise in depending on the journey that you're going to go on. My advice would be certainly for deals number 2 or 3 would be to consider building an advisory board. Part of this helps with credibility. Part of this helps with running the companies. Part of this helps with funding. So an advisory board for me could be, a lawyer, a legal expert, an accountant, finance expert, and maybe an industry expert, and you can maybe have two or three of those industry experts as you grow. And where do you find these people? Well, I'd probably be looking for sort of semi-retired or retired, lawyer from a top 10 international law firm. An accountant, I'm probably looking for somebody that's worked for one of the big four, had an extensive experience, maybe in auditing, finance, particularly if they've got that experience. In the particular industry that you're in, and having some well seasoned chairman, non-exec that's got 30-35 years experience of running companies in this particular industry. Now, if you build a board like that, where do you find them? Well, look on LinkedIn. You've outreach to them. You explain that you've acquired a company in this space. You're looking to go on a buy and build. You're looking to build an advisory board of experts to help with the journey, and in return, you're willing to share a percentage of what you're creating. You position yourself as a facilitator, so you're the person that's going to bring the deal to the table and get it over the line, and they're going to bring their various levels of expertise to support the process. So number one, that helps with running and growing these companies, because you've got 100+ years of experience of people that have probably been there, done it, worn the t-shirt many times, and that experience can be invaluable. This can also help you from an M&A perspective, from a credibility point of view, because when you're talking to business owners, if you can say, look, here's my board, and it's world class, is going to help, and it also helps as well with finding professionals to work with, and also funders. If your lawyer's a 30-year lawyer that's worked for a big top 10 law firm, well, opening up his or her contacts to law firms that are prepared to work on a fixed fee contingent basis is going to be far better received from somebody that's a peer than maybe you, that's coming along as a sort of more novice deal maker. Going into a funding meeting with that level of experience, and also having an amazing finance expert, all of these things build credibility, build experience, and that's really what funders and stakeholders are looking for. Is they're backing the people and the plan. Is the plan deliverable? Are the people behind this acquisition got the ability to execute on it? What have they done before? All of those things give credibility. So we go on this journey, we make several acquisitions, we put companies together, we build an amazing world-class team of people that ultimately take over the day-to-day stuff. That essentially makes you redundant from the business, and that's really where you want to be when you're ready to exit, because if you're involved in any way, shape or form in the day-to-day runnings, operations, oversight of this business, then it's likely that any structure that a buyer will offer you is going to have some form of earnout or deferment in there. So if you can make yourself completely redundant, you're purely a passive shareholder, that's the best position to be in. Before I sell, I want to maximize my EBITDA. Most companies, there are some nuances, but the vast majority of industries sell for a multiple of EBITDA. So the higher you can make EBITDA, the better. So bring some clever accounting experience in to make sure you do that. And also demonstrate forecasts for what the future looks like. If you're about to win a big contract, if you've got a super big pipeline, they're all things worthy of presenting to a buyer. Always get more than one horse in the race. So really, probably find 2 to 3 buyers that potentially could be interested. The way I'd approach that is I'd write a long list of people that might be interested. So think customers. Are any of my customers, could they buy me? Could my competitors buy me? Is there anyone in my supply chain that might be interested to buy me? Or is there any private equity activity in this space that either they want to invest in this industry or already acquiring? Could you possibly sell to your management team in an MBO? Could you take the company public? There's many different routes for an exit, pros and cons with all. But yeah, I would probably write a long list to start with, and then sort of work back from there. So it comes on to your strategy, really, in terms of, you can follow this process to do deals, whether you're watching today where you've already done a deal or multiple deals, or whether this potentially could be your first rodeo. For me, my recommendation is, look, this is a process. We've spent 16, 17 years refining it. And I think with every deal we do, we always learn something new, and that then goes into refining the process to, constantly, we're always constantly looking to improve. But my recommendation would be to not go for, far and wide, is to really stick within your niche areas of expertise, your areas of, where you've worked before, industries that you've been involved in, you've got contacts in, and if you don't have much credibility within those industries, then try and bring somebody on board or joint venture with somebody like ourselves that can potentially help with all of that. Making sure that you're positioned right before you do your outreach, and then really the outreach is to give you a pipeline of opportunities, and then we follow the structured process to qualify those opportunities and ultimately move them to offer and term sheet, and then it's really about rinse, repeat, doing multiple deals. Just a few of the documents that I probably wanted to share with you that we've not gone through. So let me just have a look what I've got to share. No, I think we've probably looked at everything that I would want to share with you. Let's go back into the slides. So we are coming towards the end of the webinar today. There will be an opportunity for Q&A. So if you do have any questions, feel free to drop them in the chat, and we'll address them very shortly. But the reason that I run these webinars, the reasons why I share my expertise is, as I said, we've done 110 transactions over the past 16, 17 years, and the vast majority of those have been working with like-minded people on a joint venture basis. I think, is it better to own 100% of something small or 50% of something quite large? If we have people around the world ultimately understand the process, that can deploy this process into their own industries of expertise, and then that essentially enables us to build multiple groups and do multiple deals and ultimately create exits, which is what we're all working with. So whilst of course you can follow all of the stuff I've spoken about today and implement it yourself, or go and work with other people, if you're working with me, I do work with a limited number of people. So typically I work with maximum 10 people at any one particular time. We do have a couple of openings at the moment where we've exited from successful partnerships. So there is an opening for a couple of people to work one-on-one with me. So that, whilst we have a whole team here, OPC Capital Partners that can support the process, lawyers, accountants, people on our payroll that do all of those parts of the process. Ultimately, this is an opportunity to work one-on-one with me. You can find out more about that at paulseabridgeconsulting.com. But essentially what we do is that we'll source together off-market opportunities. We'll make sure that you're positioned as a credible buyer in the way that we've spoken about today. Together, me and you will speak with business owners, and we'll work together to refine your approach. We'll structure offers that ultimately get accepted, and then we run the whole fundraising process once the deal's agreed, and then we have the whole team in place that can ultimately help navigate the due diligence, the legal process, and the closing. When I did my first deal, even though it was with my mother, and I was, I suppose, a naive 19-year-old, I very quickly learned that actually, if you've not done something before, surround yourself with people that have. So very early on in my career, I sought out some mentors, some very successful business people, entrepreneurs, billionaires, M&A experts, and I suppose a lot of what I've learned, and I suppose the reason we've been able to do 110 plus transactions is a lot to do with surrounding myself with those people. So certainly if this is your first rodeo, you've not got lots of experience in deal making, working with somebody that's been there, worn the t-shirt many times over, even when things go bad, because not every deal goes right. Sometimes they don't work out as you want them to, and having that experience of what to do when it goes wrong is almost as valuable as actually what to do when things are going right. But together, the aim is to build that momentum so that we can create multiple acquisitions, not just one-off. So a couple of people that I've worked with to reference, Sally started working with me in the summer of 2024 and has since bought three companies in their group now. They probably have around about 80 million of revenue and probably around about 6 million of EBITDA, and they're probably looking at exiting from that group at probably some point in the next 12 months. David built the fastest growing private hire group in Europe. We together did 28 acquisitions and built a large group that was ultimately majority sold to private equity in Singapore that was looking to get into the into the industry. So different people, but essentially they followed the same roadmap. And I guess, look, most people fail not because they lack intelligence, but it's because they fail to implement correctly. I guess, people take courses, but they don't execute, or they say the wrong things to sellers, or they kill deals with poor structuring, or they maybe approach the banks and the funders at the wrong time, or, they lose confidence when maybe things don't when things get difficult. So this is very much different because it's working one-on-one with me, a deal maker that's done 110 transactions in 33 different industries in 12 different countries. I've raised $500 million in capital over the past 16, 17 years of doing this. And I've written several books on the whole M&A process and business, and that raw experience really is, great, not just when things are going good, but also when deals don't go to plan. That's what creates the results. So, yeah, working one-on-one with me gives you that private coaching. We'll have regular sessions. You'll have personal access to my WhatsApp. We'll be working live on deals. You'll obviously get me and my full team of capital raising and guidance to do these transactions. Obviously, access to my global network, including the 900 plus investors that we've built relationships with over the past almost 2 decades. And then there's the opportunity to create a deal partnership where essentially we're 50-50 partners in a buy and build group, and ultimately we can hopefully exit from within a sort of 3 to 5 year period. It's very much a high touch, high commitment, high value approach. So yeah, if this resonates with you, the next step would be to book a call with me, and you can do that by visiting paulseabridgeconsulting.com. If you're interested to learn a little bit more about the process in more detail, I've written several books. So Buy, Build, Sell, I wrote in 2023, which charted some live examples of a number of the deals that I'd been involved in, I suppose what I'd learned along the way. Leverage buyouts is very much the process gone through today, but obviously outlined in more detail that a book can provide, and maybe a webinar over a few hours. Buy It With Debt talks about how you actually raise the money to do the transaction. So I mentioned that most people talk to the banks once they've got the deal. Actually, you need to talk to the bank way before you even get a deal. And the book basically goes through the process of what we do with every acquisition. Built to Sell Well is basically how you maximize the value, how you sell. We've created several, 6, 7, even 8-figure exits over the years, and the book sort of charts how we've been able to do that and what we've learned along the way. And then the Deal Makers Playbook is really combining all of those things, and it basically gives you 100 real business acquisition lessons that I've learned, which I wrote earlier this year. So to summary, before we get into the sort of just the final bit and the Q&A, sourcing starts once you're positioned in the right way. You've got to look the part. Sourcing is very much about creating the habit to make sure that every week, without fail, you've got 75 to 100 letters or more if you've got the capacity to do more. You've got maybe 15 hours a week to be able to put into this process. Most of the time, all of the sourcing can be automated. If you're joint venturing with us, we'll basically get the data for you. We've got our own software that will give you a CSV file all of the business owners' names and addresses, emails, LinkedIn, etc., that you can then plug into your software tools and automate the process, so that most of the time 95% of your working week is going to be on first and subsequent meetings with business owners. We have that process of fairly structured initial meeting to build rapport, but also to qualify them, find out why they want to sell, when they want to sell, how motivated they are, so you can decide whether to take them forward. You're obviously going to work with the most serious, not the most speculative. They might be someone to nurture over a period of time. We've spoken about objection handling, typically around valuation and deal structures, but if you set the expectations in those first calls, it means that those objections most of the time tend to fall away. We've gone through the deal analysis, so how we sort of structure deals, how we make those ballpark offers, and then how we formalise that into a more detailed formal proposal that we make to the seller. That hopefully we then get accepted. We then lock that into the term sheet, which is the roadmap that we give to the lawyers to put the transaction together. We've talked through the fundraising process of, we approach the banks way before we even do a deal to get their appetite. And mainly it's asset-based funding, and the process that we follow of sort of, building the due diligence, the financial model, sensitizing that model to show different scenario planning so that lenders can get really comfortable. Gone through the due diligence of how we sort of assess the business. It's not to chip the price, it's to go in with our eyes open to really understand the business and flush out any key risks that either we get comfortable with and we mitigate within the legal contract, or we walk away from the deal. It doesn't happen very often, but sometimes the best deals you do are the ones you walk away from and that you don't. But we've gone through the legal process, how we manage communication with all key stakeholders. We've spoken about the growth post-acquisition. So, really it's about modernising, improving, mainly sales and marketing, financial re-engineering, and that sort of stuff. So, we'll dive into final Q&A now. As I say, for me, the most successful traits I see in people that are really successful at deal making are the people that take action. They don't sit back. They're persistent. They're tenacious. They keep going. You've got to have a lot of rejection in this process. It might take 100 people you've got to speak to before you get a yes. You've got to be able to have the tenacity and thick skin to deal with all of that. And if you're interested in partnering with me, as I mentioned, paulseabridgeconsulting.com, book a call. I'm happy to chat through your ideas on deal making and see whether or not there's an opportunity for us to work together. So let's dial into the questions. Okay, so let's just work from the top. Thanks. I look forward to getting the recording from you. Okay, yes, the recording will be sent to all the delegates at the end of the webinar. Anonymous attendee, what is your criteria for working with you, certain size businesses in terms of EBITDA, certain industries? Yeah, so if you're going to work with us on a joint venture basis, on that sort of one-on-one basis, as I said, we work with maximum 10 people at any one particular time. We've got a couple of openings at the moment. We will never work with somebody where we already are involved in a particular industry if there's going to be a conflict of interest. But look, there's many industries out there. It's very rare that there's going to be some sort of conflict. So I think I would probably ask you the question back really in terms of, what's your area of expertise that you might see an opportunity in, and I'll tell you very quickly whether or not that conflicts with anything that we might be involved in at the moment. There's only 8, so there shouldn't, there probably won't be. In terms of size, the common myth I would say is that actually you probably want to start with a small deal, and once you've done a multiple of small deals, then maybe you move on to the larger transactions. I actually find that it's easier to do the larger transaction because, look, if you've got a 50 million revenue company that makes a few million quid a year, chances are that's not an owner-operated business. It takes a whole management team to probably have built that business and run that business. There's going to be an MD, an FD, a commercial director, an operations director, and there's going to be a whole top team of people that run that business. So it probably reduces the risk quite somewhat. It's not reliant just on whoever the owner is. And you also tend to find that business owners that run a company of that size tend to be more commercial, tend to understand, even if they've not done M&A, they probably tend to have an understanding of how M&A works. So, when you're talking about leveraging assets, leverage buyouts, seller financing, they're probably well aware of all of those things because you have to be if you've built a business that size. Whereas if you're running a company that's only 1.5 million, the chances are the book stops with you as the owner. It's probably very reliant on the owner, and they probably have unrealistic expectations because they probably won't have any experience of M&A. So talking about seller financing and thinking that you've got some magic pot of your own money that you're going to invest, it doesn't work like that. I mean, I use the analogy that it's a bit like buying a house. Sometimes people buy a house for cash, but it's very rare. Most people tend to put a small deposit down. They then borrow the rest from the bank to buy the house. And this is no different. And even the largest deals. I mean, if I look at one of the largest deals, if it's probably the largest that's happened in the UK in the last few years, Walmart, the big conglomerate supermarket chain in the United States, sold its supermarket subsidiary Asda in the UK in a $10 billion sale. And they sold it to the ISA brothers, and it was funded by a consortium of banks. So even the largest transactions typically tend to be done with leverage. So yeah, I would focus probably on that sort of minimum 5 million, because you've probably got a second tier of management at that level, maybe up to 50 million. As you go above 50, you're then probably competing with private equity, larger trade buyers that are always going to have deeper pockets than you. So it's really trying to find opportunities in that sort of 5 to 50 million. So I've answered that question in pounds, and for our delegates that might be joining from Australia, in Aussie dollars, that's sort of between 10 and 100 million Aussie dollars in terms of revenue. And obviously, we're looking for profitable businesses. We completely stay away from anything distressed, unless we already own a group of companies, and maybe it could be a good bolt on and we could restructure. But certainly, starting out, we would not be looking at any sort of distressed acquisitions. We want to buy good, well run, long established, profitable companies that we can develop. Next question, Grant. Hi, Paul. Would love to chat to you. I have deals in a corporate environment now, looking to do this myself. So let's please chat. Yeah, and Grant, do visit paulseabridgeconsulting.com. Drop me a message through our school community or LinkedIn, or drop me an email, paul@opccapitalpartners.com, and we can book a call, no problem. Anonymous attendee, what's your fee for working with you? Is it a share of the company or a fee upfront as well? So yeah, we have a whole team of people here that support the process. So, I don't work for free. So we typically will structure something where there's some sort of retainer, where we will work with you one-on-one. But the vast majority of our remuneration is that hopefully we end up as 50-50 partners and we build a large group together. So at most, what we make out of all of this is really that equity value. Next question, do you do the due diligence in-house or outsources it to somebody to do it for you? It depends on the deal size and the complexity of it. We do have a team in-house. So to give you an example, we have a legal expert who's got sort of 20 years corporate M&A, and worked across multiple jurisdictions. We also have a lawyer in Australia as well as the UK, and various ones in the United States as well as other jurisdictions, on the payroll, as well as being able to defer to our professional firms outside. My CFO is somebody that's got sort of 30 years M&A, Big Four trained, ran listed companies. So all of these people are basically available to us to support the process. So most of the time we tend to do the due diligence in-house. We review everything, and A, we've got the capability to do that, but B, I think it's always better to do it yourself, because you get a deeper understanding than if you outsource it to somebody. That's not to say that we don't outsource in complex scenarios. So the big manufacturing deal that we did 3 or 4 weeks ago, we did outsource part of the financial due diligence to a Big Four accounting firm to support that process, because they were able to do much more detail. And the reason for that was this was partly owned by an investment company that was offshore. So there was various sort of transfer pricing rules, offshore structures that, whilst we could have probably given it a good stab, it was probably better to defer to the experts on that to basically uncover any risks. It turns out that there wasn't any that caused us concern. But yes, sometimes we will outsource it. Next question, do you have any examples of any deals you can share with us which show the financials, i.e. purchase price, turnover, EBITDA, why the seller agreed to that multiple, how you structured the purchase price? Yeah, happy to book a call and talk through specific case studies. I'll give you a very quick one. The manufacturing business that we acquired, 50 million turnover, 3.2 million of EBITDA. We paid a purchase price of 15 million for it. 9 million of that was payable on closing, funded principally through invoice finance and a small term loan, and the balance of 7 6 million was payable on a seller note over a 5-year period. That worked for the seller. That seemed to work for them. So you might say that's a bit of a high multiple, but there was a balance sheet in there as well that was probably worth about 6 million. So if you sort of take off the balance sheet, it was a 3x multiple based on EBITDA. And yeah, the seller's motivation was they'd owned it since 2013. They had an investment partner that wanted to exit, which drove the rest of the shareholders to ultimately want to exit. A lot of the shareholders were sort of retirement age. So I guess we came along and were able to structure a deal. We signed the term sheet at the end of February and we completed first week of July. What are your costs and charges? I think we've just gone through that. Next question. I have 3 insurance related businesses that do combine 75 million and 15 million of, so I assume that's 75 million turnover, 15 million of EBITDA. They're all independent, but some synergies to save costs. This is through a buy-side consultant, but the idea is to buy, restructure, and then either take public or sell to a trade buyer as a combined group. The only sticking point for me is the initial fundraising. But we've spoken to a few banks who are interested in funding it. Is this something that would be of interest to you? Yeah, I've not done any deals at all, specifically in the insurance-related space, but we have got a wider experience in financial services and professional services firms. We've built a BPO business in Asia. We've built an accounting practice in Australia with offshore back office sort of support. I guess that's given us sort of crossovers into some of the insurance space. So yes, be open to having a look at that to see what could be done there. So yeah, if you want to book a call, feel free, and we can have a chat about what you're looking to do there. So I think that answers all of the questions. If anybody's got any other questions, feel free to drop them in the chat. Otherwise, we'll move towards a close of the webinar today, slightly ahead of schedule. So I think that probably concludes all of the questions. So thanks ever so much for your time today. I hope you found it useful. As I said in my summary, it really is about following the process, creating the habits, taking action, being persistent, being tenacious. But there's over 1 million businesses in the UK owned by the baby boomer generation. There's many more millions in the United States. There's significant number in Australia. Around about a third of businesses are owned by the baby boomer generation, and they don't have a valid route to exit. I think in the US every week 10,000 businesses close every single week because the business owner needs to exit. Maybe they've got health issues and there's no one to take over from them. Their kids don't want to do it because they see how hard it is to run a business and probably want to make money on YouTube, or it's not big enough to be on the radar of private equity or trade buyers. So that gives opportunities to people like me and you that potentially can acquire them. So the vast majority of the deals that we've done have been on a joint venture basis, and anybody that's interested in exploring joint ventures and working together, do reach out to me and we can book a call, paulseabridgeconsulting.com, and we can have a chat. There's just one more final question that's come in, so I'll answer this and then we'll close for today. I've got some friends in children care that are looking to exit. They're doing 3 million of EBITDA on 8 homes and looking for 7x multiple, because that's the industry standard. Any interest in this sector? Yeah, I've done deals in that space. Would be open to looking at it. 7x multiple seems a bit racy, but it really depends on the balance sheet. It's not uncommon that in that space that they don't own the real estate, which potentially can be where quite a lot of the value tends to be. So it really depends on what the balance sheet is. But yeah, again, if you want to have a chat about that, book a call and we can chat through it and see whether or not there's an opportunity. So great. Thanks for your time. I hope you found it useful, and happy deal making.